Hello and welcome to Session 22 of the Basic Tax Course. We begin Session 22 with a review of the Sessions 20 and 21 quiz answer key. And of course, in Session 20 and 21, we were looking at the rules surrounding self-employment, income, expenses, rules for employees, rules for travel. Some of this was a tie-in to what we looked at when we discussed employee business expenses back under itemized deductions, because many of the rules for business expenses for employees are similar to the rules for people who are self-employed or essentially running small businesses. But of course, the session on self-employment, the two sessions that we covered self-employment went much more in depth and went into a lot more concepts, including the very first concept covered in the quiz, which is question number 1. A church minister must pay self-employment tax on which of the following sources of income? Rental value of his home provided rent-free by his church, housing allowance, or wedding and funeral expenses. And you can see here that D is the correct answer. Now, it is possible to really spend an entire class discussing nothing other than rules for the clergy. They are considered to be a very specialized group. But also, interestingly, you never know as a tax practitioner when you're going to end up with a clergy member sitting across your desk during the tax season. And so although you could say that the rules for clergy are rather specialized, the reality is that clergy are frequently tax clients, and it is important to have some concept of basic information about the returns. And in particular, the rules surrounding self-employment tax with clergy are important things to know and really coincide with concepts around self-employment tax and self-employment income, which is why we threw some clergy concepts into this session. So when we look at a clergy, there's essentially a rule out there, it's in the tax code, that clergy members must be responsible for paying their own self-employment tax. They operate as employees of their churches, but the church is not supposed to do withholding for Social Security or Medicare tax or make those payments on 941s. Rather, instead, the clergy member, although treated as an employee, is responsible for paying the equivalent of Social Security and Medicare tax by filing Schedule SE. Further, clergy members, if they meet the rules, can receive tax-free housing allowance or housing assistance from the church. And there's a lot of different rules about how the church and the clergy member will determine the amount of rent-free housing that that clergy member can receive. But whatever that net valuation or that end valuation of that housing is, the housing is provided to the clergy member income tax-free, but not self-employment tax-free. And so a clergy member is required to pay self-employment tax on the rental value of his or her home that is provided by his church, also on any housing allowance if the housing allowance is provided in lieu of free housing. And finally, if that clergy member does additional work on the side and gets direct cash payments for weddings and funeral fees, then those too are subject to self-employment tax. So in the end, D is the correct answer for question number 1. Question number 2, Jake is self-employed and single. He pays all of the support of his 8-year-old daughter, Jackie. Jake had no employees during the year and has the following income and expenses to report for the year. Gross receipts from self-employment, $30,000. Self-employment expenses included advertising, supplies, depreciation, medical insurance premiums, and child care. Now, what I've done for you here is I've highlighted in green those expenses that are a yes. Yes, they're deductible, and they can be subtracted from the gross earnings up top. But these other items, medical insurance premiums and child care, those may be deductible elsewhere on the return, but they are not considered to be business expenses for the self-employed. They're definitely not allowed to be entered on Schedule C, although I frequently see these two particular items entered on Schedule Cs by both taxpayers and tax preparers who don't know what they're doing. And that's why we throw them into this particular quiz question, just to throw two of the most common no-nos at you as a student to see whether you fall for them. And since this is a frequently missed question, it appears that lots of you are still falling for it. So again, let's look at what is allowed. Advertising, supplies, depreciation. We know that those are allowed. And so we take the $30,000 of gross receipts and subtract those three numbers out, and you get $22,500, which happens to be D and is the correct answer. But with the medical insurance premiums, If a self-employed person pays medical insurance premiums for themselves or their family members, those are deductible by that person as an adjustment to income, provided they have net income from self-employment and they meet all of the other conditions for being able to claim this self-employed health insurance deduction. And for child care may be a necessary expense that a self-employed person incurs in order to give themselves the ability to do their self-employment or engage in self-employment. But child care paid by a self-employed person for their own needs is not deductible on the business. We tell you in the wording of the problem here that Jake has no employees. And so because he has no employees, you can assume that the medical insurance premiums and the child care were paid for himself, not for any employees he had. Now, if he had employees, these deductions would be possible, could be allowable if they were paid for his employees and not himself. But since he has no employees, you know they're out, and that is why D is the correct answer. Question number 3, which of the following is not a deductible expense on Schedule C? We see commissions paid to an independent contractor, draw taken by a proprietor against self-employment earnings, wages paid to a proprietor's self, and FICA taxes paid on employee wages. And then, of course, we've circled B, draw taken by a proprietor against self-employment earnings, as being the one correct answer. And this is because all of the other items are deductible. Now, did you get this one wrong because you read the question backwards, which is a possibility? Maybe you read it, which of the following is deductible, and you were searching for the one that is deductible. So it is important when you're reading a question to make sure you're reading whether this is a search for the one non-deductible thing or the one truly deductible thing. That's the first thing. But if you did read the question correctly and you still didn't get the right answer, let's look at the logic behind the draw taken by a proprietor against self-employment earnings. When you are figuring on Schedule C, you are entering on Schedule C allowable deductible expenses of the business. And when you're done with that figuring, you're left with a net number, which is the income of the business that will flow through to the 1040 return and be taxed on that 1040 return as income of the proprietor. You can't claim an expense for proprietor's draws against the business because that is income to that proprietor that has to get taxed somewhere. Now, if this proprietor were paying, say, his spouse to work for him as an employee, well, he could take a deduction for wages paid to his spouse employee because he would then give his spouse employee a W-2, and that W-2 would be entered on line 7 as wage income on the 1040 and be a reduction to income flowing through from the Schedule C. So there would be a balance there. But when a proprietor takes a draw against the business earnings for his or her own benefit, it doesn't end up on any other line of the tax return. Therefore, it's not deductible on Schedule C. So it's really kind of a logical way to sort through that. Question number 4, Jennifer purchased $15,000 worth of assets on her business on June 30th. Assuming none of the assets was a car, there is no income limit, and all of the assets have a maker's recovery period of 5 years. What is the maximum depreciation deduction that Jennifer can claim on her Schedule C, including an election to claim Section 179 expense deduction? Well, this is really kind of a dead giveaway, but it's always kind of interesting to me that so many students miss it. There's no trick to this question at all. If you place in service $15,000 worth of assets during the year, potentially you can claim a Section 179 deduction equal to $15,000. That's the maximum potential deduction. The question is, are you allowed to claim the $15,000 as a Section 179 deduction in full? So you have to look to the types of assets being depreciated. Are they eligible for the Section 179 deduction in the first place? They are eligible so long as they are not a car and limited to $3,160 per year, or they have a recovery period, essentially of 10 years or less, that makes them eligible for the Section 179 deduction, actually 15 years or less, and in some cases 20 years or less. Property can qualify for the Section 179 deduction, but generally we look to 15 years or less life in property, and if it is 15 years or less, it's eligible for the deduction. And in the problem, we tell you it's all 5-year property. Everything in this problem is telling you this person can claim a Section 179 deduction for the full cost of all assets placed in service, and that's why D is the correct answer. Question number 8. Your deduction for which of the following expenses is limited to a specific dollar amount? Well, meals are limited to 50% or 80% of the actual cost of meals, but there's no specified dollar limit on meals. Entertainment, same thing, no specified dollar limit. Gifts, however, are limited to $25 per person per year, so there is a specified dollar limit on that. And then finally, lodging. Well, there is no specified dollar limit on lodging. You might spend $50 a night for a hotel room. You might spend $300 a night for a hotel room or more. But whatever that amount is that you had to pay, as long as it's an ordinary and necessary business expense, you're allowed to claim it. So really, C should be a dead giveaway as an answer, and yet it still is a frequently missed question. Now, I haven't got any annotations on question number 11, but I'm going to take a look at this one with you as well. This is a relatively new question to our quiz bank, and in all likelihood, my staff pulled it from the enrolled agent test questions. So let's take a look at it together. Basil Company, a cash basis taxpayer, had the following activity during 2012. Sales in 2012 that were uncollected are $40,000. Sales in 2012 that were collected, $1 million. Total sales in 2012 were therefore $1,040,000. And then finally, there was a collection on a 2011 bad debt of $50,000. The question is, what is the correct amount of income to be reported for 2012? So when you're looking at this question, you have to first go up and determine, is this a cash basis or accrual basis taxpayer? The problem says it's cash basis. So cash basis taxpayer is going to pay or report into income only receipts received during the year. So we have 2012 sales that were collected of $1 million. We know that that needs to be included in income. And we also have a collection on 2011 bad debt of $50,000. The total sales of $1,040,000 and the uncollected sales of $40,000 really are not relevant for a cash basis taxpayer. We're only going to look at what physically came in to the coffers of the business. That's $1 million plus $50,000, and that is why C, $1,050,000, is the correct answer. Question number 12, same thing. This does look to me to be another C-Bank question, and I'll take a look at it, and then we'll move on to the mini problem. Lisa traveled from Philadelphia to New York on a business trip for her employer. She is not reimbursed for the travel expenses. Lisa spends 2 days in business meetings and 1 day on a vacation. Lisa's meals cost $90 or $30 per day, and lodging costs $360 at $120 per day. And then there was the train fare that cost $102. So what is the total amount of business expenses that are related to Lisa's business travel? And the first thing we have to look at in this question is, what are the allowable expenses? Because that's the question itself, isn't it? Well, when you go on a business trip, you cannot claim expenses for personal side trips or personal vacations. We've told you that 1 day of this trip is for personal. That means out of the $90 spent on meals, only $60 could be allowed. And of the $360 spent on lodging, only $240 could be allowed. We then have the train fare cost that was $102. Well, whether she took a side trip for vacation or not, that train fare is a constant. So the $102 will be allowed in full. In addition to considering which expenses are allowed and which are not allowed, you also have to consider that the meal expense is going to be multiplied by the 50% limit. So of the $60 of meal expense that could be allowed, half that, or $30, actually will be allowed. So we're going to take 30 for meals plus 240 for lodging plus 102 for the train fare. And when you add those three numbers up, you get $372, which is why B is the correct answer. Now let's move on way down the quiz now till we get to the mini problem. Briar Rabbit has started up a produce store called the Briar Patch. He opened his doors for business beginning on July 1 and had the following income and expenses for the year. Gross receipts were $120,000, but he also had interest in a company checking account of $150. Then he had the following expenses: advertising, amortization and depreciation allowance, freight in charges, freight out charges, inventory purchases, office supplies, payroll taxes, salaries, and wages. In a separate sentence, we tell you that Mr. Rabbit took home $1,000 of produce for his family to eat during the year, and then on December 31, he had a closing inventory of $6,000. So let's go through and analyze this information before we go take a look at the finished forms. Firstly, when we look at the interest on the company checking account, we need to remember that interest income has to retain its separate character. Interest income that is not collected on receivables is investment interest, and investment interest is not self-employment income. Investment interest will flow through to Briar Rabbit's personal return on his 1040, and you would enter $150 on line 8 as interest income. So we completely ignore $150 on the Schedule C. It is not entered on the Schedule C anywhere. We then move on to the expenses and to the information we're providing you for as cost of goods sold. And on the expenses, I've got a table that I inserted here on the next page. And essentially, I'm identifying each expense and where it ultimately needs to go on the Schedule C. And we can see advertising will go on line 8. Amortization and depreciation that is allowed will go on line 13. And if a 4562 is required, that will need to be completed as well. Freight in charge is a part of cost of goods sold, and so it is entered as another expense on line 39 of the Schedule C. But freight out charge or shipping charge would go on line 48 as an other expense. Inventory purchase of $29,000, well, those go on cost of goods sold on line 36. Office supplies go on line 18. Payroll taxes line 23. Salaries and wages line 26. And then finally up at the top we have an inventory notation here that $1,000 of the inventory expense for the year was really for purchases that went home with Briar Rabbit to feed his family, and clearly any amount withdrawn for personal use is going to have to be subtracted out of inventory cost. And then on the closing inventory, that's an important figure. We're going to need to put the ending inventory onto the Schedule C. So let's go take a look at Briar Rabbit's finished Schedule C. So you can see we start off by taking this $120,000 of gross receipts. That has been entered on line 1. And then you can see on line 4 we've entered cost of goods sold at $28,000. So let's just see where that figuring came from to come up with $28,000. Firstly, we look to purchases. And in the wording of the problem, we're telling you that inventory purchases were $30,000. However, $1,000 of produce went home with Briar Rabbit to feed his family. So we're not going to be able to enter $30,000 onto the Schedule C. We must reduce that by $1,000 and enter $29,000. Then we'll see that we have other costs entered on line 39. And the other costs come from freight in charges of $5,000. So you can see we've entered $5,000 there. And then we add $5,000 to the purchases for the year, and we end up with $34,000. Now, $34,000 is not the allowable deduction for cost of goods sold because cost of goods sold must be reduced by the year-end inventory, and we tell you in the wording of the problem that is $6,000. So once we take 6 from 34, we're left with 28, and that is where this amount came from that has been entered on line 4. Next, we move on to the rest of the Schedule C, and you can see that we've entered advertising on line 8, we've entered the depreciation on line 13, we've entered taxes and licenses on line 23, wages on line 25, and other expenses on line 27A. And of course, line 27A is pulling over from page 2 of the form, where we've entered freight out costs of $2,500 that carried to line 48, just as we tell you in the wording of the problem that that amount will appear on line 48. So the amount shown on line 48 is entered on line 27. So that concludes this review of the Session 21 and 20 quiz answer key. And let's move on now with the Session 22 lecture. Hello and welcome to Pacific Northwest Tax School's presentation of Amended Tax Returns, the Kiddie Tax, and Penalties. I call this my mishmash course, or everything except the kitchen sink course. And many topics, for example, itemized deductions, fit nicely into an itemized deduction course. So it's a pretty varied course. We're going to cover a lot of different material, and it's going to be kind of fast-paced and varied as a result. I have a reading assignment in the manual, and most of it's excerpted from publication 17. But there are other references you can go to in the IRS publications aside from that for reading material. But those were just kind of some short, sweet places we figured that you should read because they do a nice job of summarizing much of what I'm covering in today's class. But let's take a look at what we are going to be covering. We're going to be looking at the rules that apply to reporting uncollected and Social Security and Medicare tax on wages, also the household employment taxes, the first-time homebuyer credit recapture, various refund delivery methods that are available to filers. We're also going to be looking at the injured spouse rules and then comparing those to the innocent spouse rules because they're actually quite different, very different in purpose and intent as well. We'll be looking at how to pay the amount that you owe, but also if you can't afford to pay it, ways that you can get additional time to pay it, the different methods that IRS has for installment plans. We're going to look at estimated tax law rules and penalties that apply to them, and also perhaps some ways to get out of those penalties. Learn about how a taxpayer can be represented by a tax preparer in front of the IRS, be able to prepare and assemble an amended tax return, and finally, we're going to finish it all up with a look at the Kiddie Tax Rules. The very first page that we're going to look at is the back page of 1040, side 2, page 2. And the reason I have this page up is we're going to be looking at this little section here in pink, but we're also going to be discussing quite a bit about line 44. I can talk about line 44 for pages and pages, if you can believe it. Briefly, we'll touch on the alternative minimum tax as well. But to get it all going, I did want to point out line 43, because when it comes to calculating the tax for line 44, line 43 is typically where you start. You start with your taxable income. And your taxable income is your income after you've subtracted certain deductions. So on the first page of 1040, you figure your income, you figure any adjustment to income items that you might have, so that you arrive at a number called your adjusted gross income. And you enter that on line 37, the very bottom line of 1040. You then pull that line over to page 2, entered on line 38, and you keep going. And the first thing that you enter on line 39, after line 38, is of course either your itemized deductions or your standard deduction. You then do a subtotal, and then you enter your exemption deduction. And after you subtract out your exemption deduction, you finally arrive at your taxable income. That's the point at which you go and figure your tax. And for most filers, it's pretty elementary. You're going to go to the tax tables and look up your tax. But in a number of different situations, tax is far more complicated than that. In other words, figuring your tax is going to be more difficult than simply turning to the tax tables. So we're going to take a look at some of the methods that are used to calculate tax above and beyond just simply using the tax tables. We'll briefly touch on the alternative minimum tax, but not a focal point today at all. That's a topic in and of itself, and I do cover that. I believe I'm holding it in, sometime in July or August. I'll be covering alternative minimum tax there. I have a course called Understanding the Alternative Minimum Tax. And then we'll move on to a look at the unreported Social Security and Medicare tax and the household employee tax. All of the other taxes that you see here are covered in other courses, so we won't be spending much time on those. But in particular, unreported Social Security and Medicare tax on wages and the household employment taxes and even the first-time homebuyer credit. Today is where we're going to be looking at much of that. And then, of course, right down here on line 77, it says amount you owe and then estimated tax penalty. You may or may not have noticed that your tax software might occasionally be throwing a number on that line, the estimated tax penalty. And the tax software, if it's smart enough, can be pulling information from the prior year tax return of that client, combining that information with what appears on this year. And if the numbers work in a certain way, the software will calculate a penalty. The penalty that the software calculates may or may not be correct. And as a tax practitioner, it's your job to actually understand the formula that goes into calculating that penalty so that you can decide whether that penalty is correct or whether you can do something to eliminate it. So we'll talk a little bit about that today as well. Moving on to the next page of the manual, the very first line we're going to talk about is line 44. I already said that line 44 is the line on which you enter your tax. And your tax is normally pulled from the tax tables, but if the taxable income that appears on line 43, if this number on line 43 is $100,000 or more, you can't use the tax tables. Tax tables have to get thrown out, and you have to turn over to using other resources that the IRS provides. Now, one of the resources in Pub 17 is these tax rate schedules. You can see we've got Schedule X, Schedule Y, Y1, Y2, and Schedule Z. And these schedules are interesting because very often I have clients who will say to me, well, what exactly tax bracket am I in? How much tax am I paying as a percentage of my income? Well, your tax rate as a percentage of your income, your marginal rate we might call it, is a very different thing than your tax bracket, because every taxpayer floats through various tax brackets as their income rises. There's rather a bit of a misperception on the part of taxpayers, but also on the part of some tax practitioners, that if you move into a higher bracket, all of your income gets taxed at that higher rate. But that's simply not the case. What ultimately happens is, as you know, when we're looking at the back page of the 1040, you start with line 38, which is your income. You then subtract out all your deductions, and you finally get a taxable income amount on line 43. Well, in most cases, line 43 will be less than line 38, which means some of your income, for many people, a good part of their income, isn't taxed at all. But once you start being exposed to tax because you have taxable income on line 43, that's when you start moving into the tax brackets. And the first bracket that a filer will hit is the 10% bracket. And if you're single, you'll stay in that 10% bracket until your income is $8,700. Then you move into the 15% bracket, but it's only income that is over $8,700 and less than $35,350, taxable income that is less than that amount, that is taxed at 15%. And as the income continues to rise, the filer moves into higher and higher brackets until the filer, a single filer, eventually hits taxable income in excess of $388,350, and all income in excess of that number is taxed at 35%, and all of the tax owed on all of the income that is less than that number is $112,683. So ultimately, you would take $388,350 and say that the tax on that is $112,683. So that if you earned $400,000, you would take $400, subtract $388, then you would multiply that difference by 35%, add it to $112, and you've got the tax. Would it only be that simple, though? Because by the time a person ends up into this tax bracket, odds are it's going to be more complicated than that. So let's move over and see how it might be a little more complicated. So again, most people calculate their income using the tax rate tables. When taxable income hits $100,000, they have to move over to these rate schedules that you see up here. And the IRS some time ago did away with having people do manual calculations based on these schedules and instead gave them some computation worksheets. So if you go into IRS Publication 17 and you flip to page 263, that page of Pub 17 has these tax computation worksheets. They, in effect, do the same thing as a manual calculation on the page above. You can get to the same result either way, but the IRS says that it wants you to use these schedules. And you can see that what the schedules have you do is start at $100,000. And the reason they do that is that if your income's less than $100,000, they actually want you to use the tables. And as the income goes over $100,000, then the rate schedules come into play. And of course, there's a different rate schedule for each filing status, except for qualifying widow, because that status shares the same schedule as married filing joint. Now, above and beyond doing the manual calculations, it's probable that when you have a client who has certain specialized types of income, that you're going to have to do some worksheets to calculate their tax. And situations where it is necessary to use a worksheet to calculate tax are situations in which the filer has income from qualified dividends or capital gains, investment income that is greater than $1,900 for certain children, a parent's election to report the child's interest and dividends on the parent's return, or the foreign earned income exclusion is being claimed on the return. Any of those items will create a situation where you can't rely on the tax tables, and instead you're going to have to use a worksheet. I've thrown in a couple of worksheets for you. There are 4 more worksheets than what we've got here, but these are the 2 worksheets I selected and threw in today. This one is called the Foreign Earned Income Tax Worksheet. And you can see it's a 6-line form with a bunch of italicized instructions at the bottom. And then we move over to the Qualified Dividends and Capital Gain Tax Worksheet. This particular worksheet is a simplified version of a longer worksheet, which is the Capital Gain Tax Worksheet. We do the capital gain tax worksheet in our course called Sale of Assets. But for today, I'm filling out the qualified dividends and capital gain worksheet for you as it's the simpler version. On the next page, I have an illustration. I wanted to show you how all of these worksheets and the tables and the tax rate worksheets could all work together to create a net tax that is going to get entered on a tax filer's return. And the filer in our story, the character in our story, is named Tom Taxed-A-Lot. He has returned to his home in Vermont on April 2nd, 2012, after living and working in New Zealand for 3 years. He had $80,000 of wage income that he earned in New Zealand and another $50,000 of wage income that he earned in the United States. Tom also received a 1099 DIV that reported the following amounts. In box 1, he has ordinary dividends. In box 1B of his 1099 DIV, he has qualified dividends of $8,000, and in box 2A, he has capital gain distributions of $1,000. Well, right then and there, I already know I'm going to have to do a worksheet for Tom Taxed a Lot because he has $9,000 of qualified dividends and capital gains that are going to get taxed at lower capital gain rates, so I know that the tax tables are not adequate. But we've got another situation going on, and that is that when we look at Tom Taxed a Lot's tax return, we can see down here on line 21 that he is claiming the foreign earned income exclusion for the wages, or at least part of the wages, that he earned while he was in New Zealand. And because he's excluding wages under the foreign earned income exclusion, he has to do a special worksheet for that too. So right here with this tax return, which on the face of it doesn't look very complicated, we have to do 2 separate worksheets to figure Tom Taxed a Lot's tax. So starting up on page 1, line 7, you can see I'm pointing at line 7. It has FEC, meaning foreign earned income of $80,000. That's being added to his Vermont wages, and his total wages for the year are therefore $140,000. We see his total dividend income, we see his qualified dividend income, and we see his capital gain income. We then move down to line 21, and we're subtracting out $31,478 that is being deducted under the rules for the foreign earned income exclusion. And we arrive at adjusted gross income for Tom of $119,522. Now it's time to skip to the top of page 2. And at the top of page 2, we again put his adjusted gross income. Now we claim his deductions, and we've given him $6,000. It appears of itemized deductions. He must have had some tax to Vermont. His Schedule A isn't in here, but he has a small amount of itemized deductions. We then figure his income after all of his deductions, his taxable income on line 43, and we can see that that's $109,722, it looks like. And that the tax on that is $27,541. But we don't just come up with the number that is entered on line 4 without a bit of work. So let's see what we had to do to calculate the number that is entered on line 44. And I chose the foreign earned income exclusion and the capital gain worksheets to put those together because when we prepare a tax return for a person who is claiming the foreign earned income exclusion, it can be a little bit puzzling why their tax is so high. You know, they're able to exclude a certain amount of income, but whatever income is left, they seem to be paying a lot of tax on that. And that is the case, they are. And I'll show you why as we do the foreign earned income exclusion worksheet. But the other one, the qualified dividend capital gain worksheet, that's simply one that comes up all the time, and tax preparers should be aware of the rules for this worksheet, how it works, because if you're not doing your data entry correctly in your computer may not fill out the worksheet correctly. So let's start at the top with the foreign earned income tax worksheet. The first line on that worksheet asks for Tom's income from line 43. That's of his 1040, and that is his taxable income, the income at which you would normally go figure his tax. And it's $109,722. Then it says how much income is being excluded under the rules for the foreign earned income exclusion. The exclusion he's claiming is $31,478. We do a math computation and essentially add back his foreign earned income exclusion to his income. And when we do that, we get $141,200. Well, that's where the foreign earned income worksheet says stop. Now it's time to go complete the Schedule D worksheet. So we take that $141,200 and it becomes line 1 of the worksheet for qualified dividends and capital gains. Then the worksheet says how much qualified dividend income was there, and that was $8,000. And then it asks how much other capital gain income was there. There was $1,000. Add those numbers together and you get $9,000. And the worksheet says subtract 9 from 141.2 to get the income that Tom Taxed a Lot is going to use to figure his tax. And by that I mean his ordinary income tax, income that is being taxed at ordinary rates rather than capital gain rates. Because, of course, this $9,000 of income is going to get taxed at capital gain rates. So we get to this $132,200 figure on line 7. And now we actually have to go do some figuring. And the place to go do that figuring is over on this worksheet right here, the Section A worksheet. Remember, when the taxable income is over $100,000, you have to figure your tax manually. So we take all of his income that is not capital gain income and figure his tax. And when we do that, we get $30,477. Interestingly, there's another computation that we have to do, and that is to figure the amount of tax from the tax tables that would be assessed on his foreign earned income if it were not excluded. And so the foreign earned income that he had was $31,478. And if we follow that over on the worksheet, we come up with $42.86. So we've just used Section A tax computation worksheet, and we've used the tax table to come up with two numbers that we need for completing his tax or figuring his tax using those tax worksheets. So both of these numbers are going to carry back up to the preceding page, and we're going to be using those. So on line 16, this is the amount of tax that we pulled off that tax rate worksheet, $30,477. And then we also look at the amount of tax he's paying on the capital gain income. And the capital gain income is taxed at a rate of 15%. He has $9,000 getting taxed at a rate of 15%. That's $1,350. We're going to take $1,350, add that to $30,477, and we get a number, $31,827. So essentially the effect of the capital gain worksheet is to figure tax on all of the ordinary income, then figure separately the tax on the capital gain income, and add those two numbers together. But because Tom Tax-a-Lot has income that he's excluding under the foreign earned income exclusion, he's not done. He's going to have to take this number, $31,827, and carry it all the way back up to line 4 of the foreign earned income tax worksheet. And he slaps that on line 4, $31,827. Well, then remember the amount of income that we just looked up on the tax table that is for his foreign earned income. That was $4,286. We're going to subtract that out. He's not going to have to pay that tax, but we subtract it from his income that was taxed at his highest rate. So in other words, the money he's excluding under the foreign earned income exclusion, that's being thrown out, but it would have been taxed at his lowest rate. So they're actually throwing out his lower rate of tax. And the only rate of tax he's left with is his higher rates. And thus, on the remaining income that is not capital gain income and is not excluded under the foreign earned income exclusion, he's going to pay $27,541 of tax. So now we go back up and see where we ended up with this number, $27,541. So that's quite a bit of work to arrive at a final number for a single line of the tax return. And most of us are really oblivious to the fact that our computer is doing all of this work. But it is important to understand the calculations going into these numbers, because if you don't understand the worksheets, how they work and why they work, you won't be able to properly review your client's return to make sure the tax is calculating correctly. And it won't calculate correctly if you've got data entry errors and have failed to make data entry where you should have, or made data entry where you shouldn't have. Both of those can do it. So the next topic of the day is the alternative minimum tax. Just briefly, I'll touch on it to kind of give you an awareness of what it is in case you're not sure. So most of the income that we are exposed to, or most of the tax world that taxpayers are exposed to, is the regular tax world. When we fill out a 1040 and we figure all of our income and deductions, we're in the world of the regular tax. But there's also a secondary world. You might almost call it a hidden world off to the side, where separate tax calculations are going on simultaneously. Because a filer is always exposed to AMT. It's just a matter of, is the alternative minimum tax higher than the regular tax? Because only when it's higher than the regular tax does it come in and insert itself on a filer's tax return. So ordinary income tax rules that we fill out and complete on the 1040 each year allow certain deductions and credits that are used to reduce income tax. In certain cases, you may need to pay the AMT if your taxable income for regular tax purposes, combined with certain adjustments in tax preference items, is more than a certain amount. Under the AMT, certain deductions and credit items are disallowed, and other items are taxed at different rates and different times. The deduction and credit items receiving different treatment are commonly referred to as adjustment and tax preference items. AMT rules require you to refigure your tax while accounting for these disallowed items. If the alternative minimum tax results in a higher tax, you need to pay that higher tax. And when you pay it, it's simply the difference between AMT and the regular tax, and whatever that difference is, it gets slapped on line 45. So for example, if you figure your tax under the ordinary tax and it's $10,000, but under the AMT it's $12,000, there's a $2,000 difference between AMT and the regular tax, and therefore you would enter $2,000 on line 45, so that line 46 would equal the alternative minimum tax shown on Form 6251. If 6251 ultimately arrives at AMT that is equal to or less than line 44, then no AMT is due and line 45 would be left blank. So adjustments in tax preference items that can cause you to pay AMT. The most common reasons that people pay alternative minimum tax are because they claim dependents. AMT does not allow for dependents. So even if you're a moderate filer, let's just say you're a head of household filer earning $70,000 a year and you've got 4 kids at home, that can be enough that you're going to be exposed to alternative minimum tax. Also, the addition of the standard deduction. You're not allowed to claim a standard deduction under the rules for AMT. Although you are allowed to itemize and claim most itemized deductions, there are certain itemized deductions that you are not allowed to claim under the rules for AMT, and those include deductions claimed for state and local taxes, certain interest, most miscellaneous deductions, and part of your medical expenses. Also, the subtraction of any refund of state and local taxes included in gross income. Simply what that means is that if you included a taxable refund in your AGI under the regular tax, that's actually a deduction under AMT because AMT won't tax that refund. Changes to accelerated depreciation of certain property. The depreciation rate that you are allowed to use for AMT is often different than it is for the regular tax. Also, differences between the gain and loss on the sale of property that was reported for regular tax purposes and AMT purposes. Your gain under AMT may be different. It could be more, it could be less. Usually it's less. Also, the addition of certain income and incentive stock options. The change in certain passive activity loss deductions, addition of certain depletion that is more than the adjusted basis of the property, addition of part of the deduction of certain intangible drilling costs, and finally, the addition of tax-exempt interest on certain private activity bonds that you could exclude under the regular tax. Those are in addition to income under AMT rules. If any of those items are affecting your client, that's probably why they're paying alternative minimum tax. Your software is very likely to kick in and prepare a 6251 for you automatically when it's required. But sometimes IRS actually wants to see a 6251 even when your client is technically not required to file it. I've had it happen with my clients a couple of times, just where their income and deductions are such that they're not paying alternative minimum tax, but the IRS wants to see the 6251 filled out just to show for sure that they are not being subjected to AMT. And the next tax on the form is line 56, where we figure self-employment tax. You need to figure self-employment tax and pay it if you have a net profit from any of the following: self-employment, including active participation in a partnership or LLC, farming income, certain 1099 miscellaneous compensation, and wages of certain church employees are all reasons why self-employment tax needs to be paid. We cover self-employment tax in detail in our 1040 CPE series course called Self-Employment Income and Expenses, and that's coming up in just a few weeks. Line 57, Social Security and Medicare tax from Forms 4137 and 8919. Well, we covered 4137, the form used to figure the employee's share of tip tax, earlier in our series in a course called Investment, Wage, Tip, and Other Income. So I'm not going to be looking at that one today, but we are going to take a look at the 8919. So let's talk a little bit about that. Uncollected Social Security and Medicare tax on wages. If you worked as an employee, your employer should issue you a W-2. And on that W-2, the employer needs to report the total wages, salaries, tips that were paid to you during the year. However, if your employer treated you as an independent contractor by issuing you a Form 1099 instead, the IRS says that you can use Form 8919, which is called the Uncollected Social Security and Medicare Tax on Wages form, to figure and report your share of uncollected Social Security and Medicare taxes on your wages. The IRS has created this form, and it thought it was a really good idea. I personally have had no use for it ever since it came out. In fact, it's kind of been the opposite effect, at least for my clients, from what the IRS intention seems to have been. The form itself allows an employee to challenge their treatment by an employer. And essentially the employee is saying, my employer issued me a 1099 miscellaneous. They should have issued me a W-2. And because of that, I'm only responsible for the employee share of the Social Security and Medicare taxes. I shouldn't be responsible for the full share, even though they issued me a 1099. It sounds all well and good. The problem is I have yet to have a single client willing to fill the form out. I offer it up every tax season because I have these discussions with my clients every tax season. Lots of my clients get 1099 miscellaneouses when they shouldn't have, and I explain to them procedures for minimizing their tax or getting out of some of the tax burden associated with a 1099 miscellaneous. Not a single one has been willing to do it since this form came out, and I think it's been out for 7-8 years now. So it's been a bit of a challenge for me. But be that as it may, I will explain the rules to you, because if you know the rules, then you can explain them to a client you have who may benefit from knowing them, and then your client can make a decision for themselves as to whether they want to do it. Now, the criteria for using Form 8919 is the stopping point of the 8919, and it isn't necessarily the form itself. It's that the form can only be used if you have filed Form SS8 or in certain other situations. And Form SS8 is what really creates the problem. So you must meet one of several criteria before you can use Form 8919, and these criteria include that you filed Form SS8, Determination of Worker Status, for purposes of federal employment taxes on income tax withholding, and you received a determination letter from the IRS stating that you are in fact an employee of the firm, or you have been designated as a Section 530 employee by your employer or by the IRS prior to January 1, 1997. Or you received other correspondence from the IRS that states you are, in fact, an employee. Or you were previously treated as an employee by the firm and you are performing services in a similar capacity and under similar direction and control. So let's just say you had a job and your employer was paying you with a W-2. And a day comes where the employer says, we're going to change your worker status. We're going to call you an independent contractor from now on. Job's the same. Everything's the same. There won't be any real differences except we're going to stop holding out tax. And the employee goes, oh, that sounds cool. I don't have a problem with that. I'm going to have more take home. I like that. And then it comes tax time, and that employee finds out, hey, well, gee, I owe all of this tax because my employer switched me off a W-2 to a 1099 miscellaneous. Well, that would be a reason to use the Form 8919, because they used to be an employee and the employer changed things without actually changing any treatment of the employee. Or your coworkers were performing similar services under similar direction and control, and they are treated as employees. So everyone around you is doing the same job you are. They're treated as employees. They're getting W-2s, but the employer is giving you a 1099 miscellaneous. That's wrong. Your coworkers are performing similar services under similar direction and control, and they filed Form SS8 for the firm, and they received a determination that they were employees, because if they are employees, then you're an employee under those rules. Or finally, you filed Form SS8 with the IRS, but you haven't yet received a reply. So there seems to be very little way around this SS8. You either have to file the form and have received a response, or you have to file the form and be waiting for a response, or you have to have coworkers who filed the form and they've received approval from the IRS that they are employees, or one of the other exceptions you see here. So let's just suppose one of those applies. Now you get over to the 8919 form, and it says who must file. You must file Form 8919 if all of the following apply. You performed services for a firm. You believe your pay from the firm was not for services as an independent contractor. The firm did not withhold your share of Social Security and Medicare taxes from your pay, and one of the reasons listed below under the reason codes applies to you. And so you have to pick a reason and enter it in column C. A, I filed Form SS8 and received a determination letter stating that I am an employee. C, I received other correspondence from the IRS that states I am an employee. G, I filed Form SS8 with the IRS and have not received a reply. Or H, I received a Form W-2 and a Form 1099 miscellaneous from this firm for 2012, and the amount on the 1099 miscellaneous should have been included in my wages. So if none of those apply to you, then you can't use the form, and you're essentially stuck filing a Schedule C and paying the full amount of the self-employment tax, or entering it as other income, or entering it even on the wage line and attaching a Schedule SE for the full self-employment tax. There's just simply going to be no way around the self-employment tax issue. So what is this Form SS8? It's actually a pretty interesting form, because certainly in my course of being a tax practitioner, I regularly and frequently run across employees who are questioning their employment status, but also employers who may be wondering about whether or not a particular worker should be classified as an employee or not. And so this form is used and can be used by both an employee and an employer, whoever decides to submit it, to establish worker status. So the courts have considered many facts in deciding whether or not a worker is an independent contractor or an employee. These relevant facts fall into three main categories, and they include behavioral control, financial control, and the relationship of the parties. In each case, it is very important to consider all of the facts. No single fact provides the answer. IRS Publication 1779, Independent Contractor or Employee, ? provides information that can be helpful in determining whether or not a worker is an employee or is self-employed. And this particular publication, 1779, is really like a trifold brochure. Purple, it's almost like something you could order from the IRS and have sitting in a brochure holder on your desk for situations where you have employees or whether you have clients who are employers who have questions about worker status. And it's a rather important topic, both sides. If you have an employee who's being treated as an independent contractor, you really should understand what their rights are and how you can assist them through that mess. But if you are providing services to the employer as a tax consultant or a tax advisor, you should be advising them on their legal obligations with respect to their employees. And if you observe them engaging in activities like treating people as independent contractors when you know they shouldn't be, you really have an obligation to let them know that what they're doing is inappropriate. So having this 1799 handy, either printing it off on your printer from the IRS website or even ordering them and having a few handy and handing them to your clients, is protection for yourself and protection for them. And it has a nice synopsis of the rules. If you are not sure whether you are an employee or an independent contractor, you should complete and submit Form SS8 to determine your worker status. Also, in IRS Publication 15A, the Employer Supplemental Tax Guide provides additional information on independent contractor status. There's no shortage of information out there in terms of what resources you have available to you to read about and try and identify or determine whether or not a worker is an employee. For me, I find it pretty cut and dry. If a worker is told where to work, how to work, what tools to use, how to perform their job duties, as far as I'm concerned, they're an employee. And it's better to err on the side of caution than to err on the side of, well, whatever. You know, if the IRS audits, so what? Because if the IRS does audit and you're the employer, it's not going to be pretty. The taxes and penalties can be quite huge. We'll get into those more in our self-employment course because this is not a class about what the employer will suffer, but we do cover those issues in our self-employment course. Form SS8 may be filed by a firm or a worker to request a determination of the status of a worker for purposes of federal employment taxes and income tax withholding. The form must be submitted for a tax year for which the statute of limitations on the tax return has not yet expired. So typically that would mean within 3 years of the due date of the return. The statute of limitations expires 3 years from the due date of the return, which is what the next sentence says. So here is my comment. I'm the author. While Form SS8 appears on the surface to be a useful tool for establishing the true nature of an employee-independent contractor relationship, few employees are willing to file the form. And objections I have received from every taxpayer I have offered the form up to include: they don't want the IRS looking at their personal business. The less the IRS pays attention to them, the fewer questions the IRS asks, the happier they'll be. Also, the questions on the Form SS8, they think they're too probing. They don't want to have to give that much information. Also, they don't want to aggravate their employer and risk losing that job, especially in the last economic recession we had. It was bad, and anyone who had a job didn't want to do anything to mess with that. And finally, they do not want to create a problem for their employers even after employment ceases. I've actually had employees who hated the job they had. They were treated badly. They were not paid correctly. They left that job, and even after it was all over and they even had an opportunity to maybe get even, they didn't want any part of it. Nothing. So I have just yet to have a client take advantage of this form, and this is despite having offered it several times every tax season for years. So here is the SS8 form. I'm not going to read it, but I did throw it in the manual. If you are interested in it, you should take a good look at it and read and be familiar with the types of information it asks for, so that when you are broaching the subject with your clients, you can be ready to inform them about the types of information they will need to provide on the form. And you can see it goes on and on and on with 4 pages of questions, all of which are quite personal and probing in nature. Next line we're going to talk about briefly is line 58. That is the line that we figure additional tax on IRAs, other retirement plans, etc. We took a really long look at this particular line in our course called Pension and Social Security Income, so I'm not going to revisit it here today. Simply said, if you take an early distribution from a pension plan or an IRA, you may be subjected to a 10% early withdrawal tax. And in the case of a simple IRA plan, the tax can be as high as 25%. If you're subjected to that tax, you need to calculate it and you need to enter it on line 58 of the 1040. Now we're coming to a line where we are going to spend a bit of time, and that is line 59A, household employment taxes. If you had a household employee during the year, you may be required to pay Social Security and Medicare taxes for your employee. If you choose not to file Form 941, which is the employer's quarterly federal tax return, you can file Schedule H household employment tax and include that form with your tax return instead. In addition, the Schedule H can actually be filed separately all by itself and mailed in as a separate return. You are required to pay payroll taxes for your household employee or employees if you meet either of the following tests. Number 1, you paid $1,800 or more to any one household employee during the year, or you paid $1,000 or more in any calendar quarter of either 2011 or 2012 to all of your household employees combined. So why are these limits there? What's the purpose of those? Well, the rule is that if you have an employee, you need to submit payroll reports to the IRS on them. And there was some concern, naturally, about people who hire babysitters to come take care of their kids while they go out for a dinner on a Friday night, that do they really need to be doing payroll tax withholding on situations like that? That doesn't seem reasonable. Or you hire the neighbor's kid to mow your front lawn. Should you really have to do payroll withholding for that? So the IRS and the government together came up with a formula that says, well, we're going to make it so that only people who are really employing people, at least part-time for an extended period of time and paying them a significant amount of wage during a year, will be required to do withholding and payroll taxes for these household employees. But the rules that you're looking at here apply only to household employees. So if you're not looking at a worker who is a house employee, rather you're looking at a worker over at McDonald's, these rules don't apply. So, for example, this rule that says if you paid the worker $1,800 or more during the year, you need to issue a W-2, well, that applies to household employees. It doesn't apply to anyone else. So outside of the household, if you even pay your employee $1 for the year, you need to issue a W-2 for that. I can't say I've seen a W-2 for $1, but I have seen W-2s for $30. They do happen. So first number, $1,800 to any one household employee during the year. So you hired a nanny to come in and watch the kids, and from January 1 to December 31, how much did you pay her? If it's over $1,800, you need to file a Schedule H. You need to issue her a W-2. Or you paid $1,000 or more in any calendar quarter of 11 or 12. So let's suppose you hired 3 or 4 nannies during the course of the year. How much did you pay any one of those or all of them combined in any one quarter? And as soon as that goes over $1,000 in a quarter, now the Schedule H is required. If you are an employer who is required to pay payroll taxes, you must apply for an employer identification number, and you need to issue a W-2 to every employee to whom you paid $1,800 or more during the year. And you have to issue that W-2 by January 31st, 2013. And in addition, you need to file the Form W-3 and the W-2 with the Social Security Administration by February 28, 2013. As an employer, you are responsible for withholding and paying Social Security and Medicare taxes for your employee as follows. You should withhold 4.2% of gross wages for Social Security tax and 1.45% for Medicare tax. You may also, if you and your employee choose to, withhold income taxes for your employee. Note that if you fail to withhold Social Security and Medicare taxes, you must pay both the employee share and the employer share of the taxes. So the Schedule H form has a calculation on it, and I'm about to show it to you, where you figure the amount of Social Security and Medicare tax owed on employee wages. That tax is owed with the Schedule H, whether you withheld it from the employee's pay or not. And if you failed to withhold it, basically what you paid your employee just went up, didn't it? Because now you're having to pay their tax for them as well. So the option to do withholding is there. If the employer fails to withhold, the employer is still responsible for paying the tax. And it is the employer, not the employee, who is responsible for payment of the tax. You may be subjected to an estimated tax penalty. If you are required to pay, or when you file your tax return, the bottom line shows that you owe $1,000 or more with your federal return, then an estimated tax penalty might apply to you. So if you do elect to have the employee's taxes paid with your own return when you file it, so you're attaching the Schedule 8 to your federal return and you're filing it that way, then you should either increase the amount of federal withholdings that you have from your wages where you work, or you need to be paying estimated taxes throughout the year to ensure that that estimated tax amount is paid in full for the year. And here is an illustration of how the Schedule H works. And I do see a question here. Didn't the Social Security withholdings go up to 6.2%? The 6.2% is for 2013, Janet, and we're still on 2012 law. So yes, it has gone up to 6.2 for 2013. All right, illustration, preparation of Schedule H. Julia, our character in this story, employed a nanny to care for her 2 children. She paid her nanny $12,000, $3,500 of which was before July 1, and $8,500 was after June 30th. And she paid it all during 2012. During the year, she withheld $500 of income tax for her nanny, and she also paid 4.2% Social Security and 1.45% that she withheld from her nanny's pay. So she withheld $500 of income tax, 4.2% Social Security tax, 1.45% Medicare tax. She withheld those from her nanny's pay. Julia also paid a state unemployment fund contribution of $144. Her EIN is shown here. After completing the state payroll tax report and paying tax due to the state, because most states do have a payroll tax report that you need to pay for household employees as well, Julia should prepare and file Schedule H as follows. So the first part of Schedule H is a series of questions. Did you pay any one household employee cash wages of $1,800 or more for the year? Well, at $12,000, clearly that's a yes. Did you withhold federal income tax for the household employee? Yes, skip C and go to line 5. So we are going to move on to Part 1 of the form. And on Part 1 of the form, we enter the cash wages paid to the worker for the year, and then we multiply that by 10.4%. 4.2% is the employee withholding portion, and 6.2% is the employer portion. You add those two numbers together, you get 10.4%. So yes, for 2013 and future years, this line will read 12.4%, but for 2011 and 2012 only, it reads 10.4%. So we take 10.4%, multiply that by 12,000, we end up with $1,248. The next step is to figure the cash wages subjected to Medicare tax. The Medicare tax rate for both the employer and the employee share combined is 2.9%. We multiply that by $12,000 and we get $348. We then enter the income tax that was withheld from the nanny's pay, $500, and we add these 3 tax amounts up. $1,248 plus $348 plus $500 is $2,096. And now we proceed over to page 2 of the form. On page 2 of the form, there's a series of questions about the FUTA tax. And the FUTA tax can be a more confusing tax because FUTA rates can vary by the state you're in. And some states, because of high unemployment rates, have had higher than normal rates, so you do have to study those rules a little bit. But typically, when you're paying your tax to the state, you are filling out state forms. You're completing state forms. And at some point, the IRS wants to know if those forms were filed and if they were filed timely. And if they were, you actually get a lower or reduced rate of FUTA tax on the federal return. But if you didn't file any state reports, then you have to pay a higher rate of tax on the federal return. So on line 8 it says, did you pay unemployment contributions to only one state? If the answer is yes, you check the yes column. Did you pay all the state unemployment contributions for 2012 by April 15 of 2013? And I've told you that Julia did. And were all of the wages that were taxable for FUTA tax also taxable for your state's unemployment tax? And in Julia's case, that is a yes. Now you'll see here that the federal rate for taxing FUTA stops at $7,000. What that means is that only the first $7,000 of any employee's wage is subjected to that federal unemployment tax. But at the state level, it might be a higher rate. What the IRS is interested in is, does the state tax at least $7,000? And in Julia's case, the answer is yes. And it asks how much was paid to the state unemployment fund, and for Julia that was $144. We then take the wages, multiply that by 6%, and we get $42. That is the unemployment tax that is due for Julia's household employee. So now we add the 42 to the $2,096, and we get $2,138. This is the tax that Julia needs to pay on her household employee, and this will be in addition to her income tax, and she will enter it on the tax line for the household employee tax of her 1040. And essentially that is line 59A of the 1040. She will enter $2,138. Baker Lake. B-A-K-E-R-L-A-K-E. Baker Lake. Let's take a look again at this question. So here is the question again. In which situation would Janice not be required to file Schedule H and pay household employment taxes for the year? We have option number A. Julie pays $1,200 of wages to her sister for babysitting in Janice's home in July, August, and September. Well, she would have to issue that because it's $1,000 or more in the quarter. So A is not the correct answer. Then we go on to problem number B. Withheld $100 of federal income tax from payments to her yard worker. Well, we don't tell you how much she paid the yard worker, but she withheld $100 of tax. So she probably paid that yard worker well over $1,800 for the year. At any rate, the withholding creates a requirement for filing the Schedule H and reporting that withholding because Julia needs to send that $100 into the government. She held it from her worker. Now she's got to turn it over to the government. She's essentially holding it in trust for that employee, and she needs to pay it to the government. So Schedule H would be required in that situation. Number C, she paid $2,000 to her mother for housekeeping. Well, that's actually the correct answer. And I didn't cover it in today's class, but if you go into the instructions for Schedule H and read those, the instructions tell you there's no requirement to file a Schedule H when you're paying your parent in certain situations. And finally, paid household help other than the mother, $1,000 for the period of July, August, and September. Well, D requires Schedule H for the same reason that A requires Schedule H. It's $1,000 or more in a 3-month period or a calendar quarter. All right, moving on with the next topic of the day. We are going to be talking about the repayment of the homebuyer credit. And the homebuyer credit repayment, I'm thinking, well, pretty quickly we're not going to be dealing with it so much because there's a 3-year rule that you should be aware of that says if you own and occupy the home for the first 3 years that you own it, then after that it can cease to be your main home or you can sell it and you don't have to repay the credit. Except for the part where we're still going to be dealing with the credit for a while, for a total of 15 years from 2010 to 2025, because anyone who purchased the home under the 2008 rules is going to be dealing with those repayments for a total of 15 years starting with 2010. But still, this past tax season, the 2013 tax season, our firm had to assist clients with preparing tax returns where the homebuyer credit had to be repaid. And in those cases, it was the 2009 credit that was being repaid. They sold within 3 years, sometime in 2012, less than 3 years after purchase, or they converted, actually in both cases it wasn't a sale, they converted the properties to rental use and had to repay the credit. So let's take a look at how the rules for this work. If you claimed a first-time homebuyer credit, either in 2008, 9, 10, or in certain cases 11 if you're a member of the military, you may be required to repay the credit. The annual repayment amount for 2008 filers or filers who claimed the 2008 credit began in 2010. And for individuals who claimed the 2008 credit, that credit is paid at a rate of $500 a year over a 15-year period. If you claimed the 2008 credit and you are simply making that $500 payment each year, you put $500 directly on the Form 1040 line 59B and you're done. There's no need to complete the special Form 5405 to figure the repayment amount. It's $500 and you put it on the form. But if you claimed any of the credits, the 2008, 9, 10, or 11 first-time homebuyer credits, and you sold the home in 2012, or the home stopped being your main home in 2012, and it was converted or sold within 3 years of acquiring the home, then you have to do a repayment. So let's take a look at the repayment rules. You must repay all or some of the homebuyer credit you claimed if during the 36-month period following the date you purchased the home ceases to be your main home and any of the following situations apply. You sold, including through foreclosure or repossession, the home to a person who is not related to you and you had a gain on the sale. If you sell the home to someone who is not related to you, the repayment in the year of the sale is limited to the amount of gain on the sale. The amount of the credit in excess of the gain does not have to be repaid. Or you sold the home to a related person. Whether you sold it at a gain or not, if you sold it to a related person, you have to repay the credit. Or you converted the entire home to a rental or business use, or you still own the home but you no longer use it as your main home, or your home was destroyed, condemned, or disposed of under threat of condemnation and you do not plan to acquire a new home within 2 years of the event. To determine how much of your credit you must repay, complete the Form 54 Gain or Loss Worksheet, 5504 Gain or Loss Worksheet shown here. And the worksheet is essentially to figure what your basis was, what your selling expenses are, what amount, if any, of credit has already been repaid in earlier years. You figure your gain, and the credit repayment will be the lesser of the gain or the unpaid credit. So here is a summary page. I found it in the IRS website. It summarizes the key points and conditions under which the various credits have to be repaid. And it says, if you bought a home in 2008 and received the first-time homebuyer credit, and you sell the home to a related party within the next 15 years, you must repay the credit amount in full, reduced by any amount of the credit that you previously repaid. You attach Form 5405 to your return for the year you sell the home. And this is required whether you had a gain or a loss on the sale of the property. If you bought the home in 2009 or 10, and it doesn't say 11, but there are certain people who ended up buying in 11 because they were military, and then you received the first-time homebuyer credit, you then sell the home to a related party within the first 36 months of buying the home, then you must repay the credit in full. If you bought your home in 2008, 9, or 10, and the home is destroyed or condemned, and you did not replace it by rebuilding a new main home within 2 years of the event, then you have to repay the full amount of the credit. And if you bought your home in 2008, 9, or 10, and you convert the home entirely to business or rental use, then you have to repay the credit. So situations where the repayment is not required. You do not need to repay the credit in certain situations. No repayment of the credit is required if any of the following exceptions apply. Your home ceased to be your main home because you or your spouse, if married, was a member of the Uniformed Services or the Foreign Service or an employee of the intelligence community, and you or your spouse received government orders to serve on qualified official extended duty service. You sold, including through foreclosure or repossession, the home to a person who is not related to you, and you did not have a gain on the sale. Use Form 5405 Gain or Loss to determine if you have a gain, and when figuring the gain, reduce the adjusted basis of the home by the amount of the credit. If you do not have a gain, you do not have to be repaying the credit. You transferred the home to your spouse or ex-spouse as part of a divorce settlement. The responsibility for repayment of the credit is transferred to your spouse or ex-spouse. If none of the allowed exceptions apply and your spouse or ex-spouse sells the home or it ceases to be his or her main home during that 36-month period beginning on the purchase date, then he or she is responsible for repaying the credit. And that was actually what happened with one of our clients this year. Went through a divorce. The wife wanted the house until she learned that she'd be responsible both for repayment of the first-time homebuyer credit if she took possession and then sold it. So she left it to the husband. The husband took possession of it and couldn't afford to live in it because he only had his income and he was paying all the spousal support and child support. So he turned it into a rental. And then, of course, he got hit with this big bill for the first-time repayment of the credit. So he obviously had a bad year. The taxpayer who claims the credit died in 2012. No repayment of the credit is required of the deceased taxpayer. Or you die, but if you claim the credit on a joint return and then you die, your surviving spouse will be required to repay his or her half of the credit if during the 36-month period beginning on the purchase date, he or she disposes of the home or it ceases to be his or her main home and none of the allowed exceptions apply. So let's look at how to repay the credit. If you received a homebuyer credit when you purchased your home, you have to recapture a part or all in certain situations. And we're going to do an illustration coming up here next of how to do a recapture of the first-time homebuyer credit for a person who used the 2008 first-time homebuyer credit. I feel this is the most likely one we're going to be dealing with over time because it's going to be around for a full 15 years in total, whereas the others, they're going to be phasing out pretty quick and we won't be dealing with them. Although I can say the two recaptures I've had in 2012 were for the 2009 credit. So when do you have to repay? Well, if the home ceases to be your main home, if you sell it, convert it to business or rental use, or the home is destroyed, condemned, or disposed of under threat of condemnation. Any of those situations is going to cause you to need to fill out 5405. And here is our illustration. Johnny sold too soon, received $7,500 as a 2008 first-time homebuyer credit. He purchased the home on July 1, 2008 for $250,000. His adjusted basis in the home is $242,500. And how you get that number is you take his purchase price, you subtract out the first-time homebuyer credit, and whether you're dealing with the 2008 credit, which has to be repaid over time, or whether you're dealing with any of the other credits for first-time homebuyer for 2009, 10, or 11, all of those credits serve to reduce the basis in the home. So you always have to be remembering, even if they don't have to repay the credit, they do have to reduce their basis in the home by the amount of credit they claimed. Now, Johnny did repay $500 of the credit with his 2010 and another $500 on his 2011 return. And then he sold the home on June 30, 2012 for $253,000. He had expenses relating to the sale of $4,500, and he figures his net gain as follows. We take the purchase price of the home, we subtract out the first-time homebuyer credit, and then we add in the amount that he repaid. And we end up with an adjusted basis in the home of $243,500. From that, we actually enter the selling price of the home, we subtract out the selling expenses, and then we subtract out the adjusted basis. We're left with a gain on the sale of $5,000. That's less than his unrepaid credit. Remember, he's taken a $7,500 credit. He's repaid $1,000, so he still has $6,500 of credit outstanding. However, his gain on the sale is only $5,000, so that's how much he's going to have to be repaying. And the form actually has you do things in a bit different way than the way I just showed you. It starts with the amount of the credit claimed, the amount repaid, and the amount still outstanding. It then says enter the gain from the sale, $5,000. And down in this section, we have the worksheet built in. Lines 9 through 15 are a worksheet used to figure the gain on the sale. They arrange the numbers in a different way, but come out with the same net result that the tax is going to be $5,000. We enter $5,000 on line 8, and we carry that over to line 59B and enter $5,000 on the line as a repayment of the credit. Now, the next line that you'll see coming up is the other taxes line. This is actually a relatively new line. IRS only inserted it on the 1040 form, I believe, beginning with tax year 2010 or 11. And prior to that, if you had any other taxes, you actually had to type them on the total tax line in this dotted area here and describe them. But beginning with a couple of years ago, the IRS actually inserted line 60, and now it has a system where if you have any other form of tax that you need to pay, enter a code to identify the type of tax you are repaying on this blank line, and then type the amount of tax you are paying on line 60. So let's talk a little bit about line 60. You enter a code on line 60, and the list of codes is on this table here, and you can see there's a lot of different taxes. The first one in line is the HSA, or the Tax on Health Savings Accounts Distributions. Just kind of looking at it in terms of what's listed on here, I feel that the one tax we're likely to run across is this HSA distribution, not used for qualified medical expenses. And so it's the only one I've really augmented or I'm going to talk to you about. For HSA and MSA purposes, the additional tax on distributions not used for qualified medical expenses is 20%. It used to be 10%. The 20% penalty applies to distributions after 2010. You do not have to pay the penalty if your distribution occurs after you reach age 65 due to total disability or due to your death. If you are required to pay the penalty associated with taking money from your HSA and not spending it on medical, you're going to complete Form 8889 and enter the code HSA. So there's two different reasons to have the code. One is basically been disallowed as a participant in the plan because you did something you shouldn't have. That's an HDHP code, and if you took an early distribution or a distribution not used for qualified expenses, you use HSA. And on the next page, you'll see all of the other potential taxes you could be paying. There's a lot of them. I'm not going to read them. If you're interested, you can look at those yourself. Moving on to the next topic of the day, which is refund or amount you owe. A number of important procedures apply when filing for a refund or calculating the amount of tax you owe and making a payment. For refunds, if you have a refund, you will need to decide how you want to use and receive your refund. You may use your refund to purchase U.S. savings bonds or to pay estimated tax. You may have your refund mailed to you, or you can choose to have your refund deposited into one or more bank accounts through direct deposit. Well, one of the things that goes on with a client, and we're kind of getting into some areas of our tax course today where I'm thinking, well, this stuff seems kind of mundane. What has that got to do with preparing a client's tax return? Do we really need to talk about this? But time and again, as a tax service manager and owner, I am astonished at what my tax preparers don't know. Over time, over the past 20 years, there's just certain things that seem to me to be self-evident that they're not even worth teaching, and yet my staff have revealed to me that they don't know these things. And simultaneously, I've had clients who come to me and complain, sometimes even publicly, say on Yelp or on Google, that they came to our service and no one here knew anything about what to do to help them with what they owed. And so we're no good. What has that got to do with preparing their tax return? I figure, preparing a tax return is, understanding tax law and filling out the forms correctly, and they're not even getting into that. They're complaining that we didn't know how to help them with their tax problem. So I feel that these items are crucially important to any competent tax practitioner, and that when your client is sitting across from you, they may not be vocalizing these things that are important to them, but you should be aware of the fact that they probably are important to them. And when it comes to their money, that's important. Whether they owe or they have a refund, they want to know all of the different methods available for receiving their money. And if they owe, they want to know all of the different ways they can pay their money. And you cannot put enough energy into explaining these items to them. So for those reasons, I've got them in the course, and we're going to spend some time on them today. The refund side of things and the amount you owe side of things, and the types of information our clients care about. When it comes to their refund, they're pretty interested in what's happening with the refund. Now, one of the ways that they can receive their refund is simply a check in the mail. That's really the old-fashioned way. They simply don't elect direct deposit, and by not electing direct deposit, it defaults to paper check in the mail. The IRS actually prefers not to do checks in the mail. It doesn't like checks in the mail. And the reason it doesn't like checks in the mail is checks get lost, they get stolen. Tax clients sometimes have trouble cashing them. It's not secure. It's not the most secure method. So the IRS far and away prefers direct deposit and encourages it. On the tax practitioner side of things, direct deposit is a liability in a way. If we get the information entered on the tax return incorrect, then our client's refund isn't going to get where it needs to be. So the onus or responsibility of making a refund go where it belongs is on the tax practitioner. And if you are a tax service owner and you are supervising workers, you cannot be on top of this issue enough, because your workers' failure to enter direct deposit information correctly is going to come back on you as a tax service owner, because you're going to be the one listening to the screaming client who didn't get their money. So procedurally, over the years, I've learned through the School of Hard Knocks the things that my staff have done over time to mess up client refunds so that they don't get their refunds like they're supposed to in a timely manner. And I developed procedures over time to ensure that we don't have these errors coming up. And it's one of the biggest areas of concern for our firm when we're processing tax returns, that if we see a direct deposit on a tax return, we are verifying that at multiple points. We're having the client sign off on it. We're having the client give us a voided check. We're having the client sign another form. it's going to the review stage, and another preparer is actually reviewing the data entry 3 times out. So by the time a tax return gets transmitted out of our office, at least 4 sets of eyes have looked at those numbers and verified that they're accurate. And even at the very last level, when that 4th set of eyes is looking at it, sometimes there's an error, which means that the client made an error, the client's spouse made an error, the preparer made an error, and no one noticed, and it still made it to the final review, and that was where the error was caught. So again, I'm kind of hyperventilating on this, but it's so important. So you will notice that there is a line here on the 1040 form where you can enter the routing number of the bank and the account number. What's the purpose of those numbers? Well, the routing number tells the IRS what financial institution to send the money to. And the account number tells that financial institution what account to put the money in. Now, around about 1995, I'd say, 1996, somewhere in there, Wells Fargo bought out First Interstate Bank in Portland, Oregon. Enter into the realm of nightmares and the point in time at which I developed new procedures. What happened was that when Wells Fargo bought out First Interstate, Wells Fargo assigned everyone new account numbers. And you could not take a First Interstate account number and combine it with a new Wells Fargo routing number and have a direct deposit occur. The only way it would go through is if you use both the First Interstate account and routing, or you use the Wells Fargo routing and account numbers. You couldn't combine the two or mix them. And do you think there was a lot of mix-up that went on? There was, because we'd have clients saying, well, yeah, this is my account number, and then we'd talk to Wells Fargo and get the routing number, but the client had given us the First Interstate number, not their Wells Fargo number. And so these tax returns, the refunds weren't getting out to clients. Wells Fargo, I think, got a lot of kickback from it. It seemed self-evident that they should have had a system in place that it could acknowledge the First Interstate routing number and kind of figure it out. To me, that's self-evident. It couldn't be that hard. And since then, other financial institutions have bought out one another in the Portland area, and they've been smart enough to just keep everything the same and not assign new routing numbers. But be that as it may, it was hell on earth for a while, and we survived it as a firm, but not without some big bruises. Now, taking the same story, I was watching a show on TV. You've probably all seen it. It's called Judge Judy, except it's not Judge Judy. There's another guy, a man. He does the same thing. And I happened to turn it on earlier this past year, and there was a tax practitioner up against his client on this show. And guess why the tax practitioner was on the show opposite his tax client? Because he'd messed up the routing and account numbers on her return, and she hadn't gotten her money. And when she didn't get her money, she called him and said, I haven't got my money. And he says, well, I don't know what to do about it. And my reaction is, oh, there was everything in the world you could have done about it, bud. And guess what? He lost on that trial. She won. She won all the money she didn't get out of him, because the judge deemed that he was ultimately responsible for the routing and account number entered on the form, and the fact that she'd given him accurate information, but that he had entered inaccurate information, was his fault. So ultimately, yes, it's on us. And the IRS may not hold us accountable, but in court, our client could get a judge to rule against us. So how do we get the numbers correct? Well, we should always ask for a check. And our clients, when they want to do direct deposit to a savings account, I don't much like that. It's not my favorite thing because I don't have a physical piece of paper to look at. But sometimes when they do have a savings account, they do get a card at the time they open the account, and the card shows the routing number and account number. And if that's what they have, I'll make a photocopy of it and save it, and I'll call that good. But wherever possible, whenever possible, I ask for a check. And this is a check that comes out of IRS publications, and they're showing the makeup of things. You can see these first digits here. There's 9 of them, 250250025. That is the routing number. And the next series of digits is the account number. So if you were to fill out this routing number line here, line 74B, you would pull this number from the check. And if you're filling out the account number, you would fill out this number from the check. But you see the next number line? This number 1234, and it's repeated up here in the corner, 1234, that's the check number. And that is not part of the account number. So what you want to do is look for the check number on the check, pull it out, and what's left would typically be the account number. And you enter that in. But here's what I do. Just to be a safe measure, I'll take the client's check and I will enter the digits from the check into the computer. Then I will print a page from the computer. In our case, Drake Software prints the 8879, and the routing and account numbers will appear on the 8879. Or you could print page 2 of the 1040 where you see those account numbers lined up at the bottom, the numbers on them. I will print that page. Or alternatively, I will hand copy the numbers from the computer screen onto a second page of paper. I don't copy them from this check here. We don't look at the check again. We've copied the information from the check into the computer. Now we're going to do a cross-check from what's in the computer back to the check. But we would never copy information from the check somewhere else as a cross-check. So we enter the information from the check into the computer that we then print out or hand copy from the computer screen what's physically in the computer. And then I staple the check to that printout or that handwritten copy, and I circle the account number and the routing number on the form and have that client initial that those are correct. That's the procedures that we've had in place. And I can say since we've implemented those procedures, the only time we've ever had a problem, there's 2 times where we have a problem. One is the client gives us a check on an account that's closed, and that happens virtually every tax season. So it doesn't hurt to ask them, are you sure this is a good check? This account's open, everything's good? Because it happens every season. The second is that early on when I implemented these procedures, I actually had an employee who didn't follow them. She just thought, yeah, it's a procedure, but I'm too lazy to follow it. She didn't follow the procedure. The account number was wrong, and of course I had a screaming client. End of story. Now, back to this check. I still have more to say. Looking at this check. Yes, it's a good idea to use the check. Yes, you should use numbers that are on the check when the check is issued by a bank. When the check is issued by a credit union, however, things are a little muddier. For whatever reason, credit unions like to make the account number different than what's on the check. And so procedurally, the IRS, for the 20 years I've been in this business, has been saying, hey, you know, if your client has a check drawn on a credit union, you should call the credit union to verify that the numbers on the check are correct. And so we do that. Every single client that has a credit union, we have to call the credit union. And the credit unions are pretty tight on security. So you call the credit union and you say, yeah, I've got a client, they want direct deposit, I'm holding their credit union check. And the credit union won't give me any information because it's confidential. So essentially what I do say is I'm calling to verify the accuracy of information being set up for a refund deposit. This is the routing number I have. This is the account number that I have. Are these valid numbers that will get my client's money where it needs to be? And what the credit union will say is, yes, that's good, or no, that's no good. And they'll say it's no good when the check has numbers different than what they use. Some credit unions drop digits, some add digits, and some use entirely different numbers altogether. And I've asked credit unions, why don't you use the numbers that are on the check, or why are the numbers on the check not a match to the account number? And the credit union will say, oh, we use that to ensure there's fraud control, that when we have someone come in with a check or using numbers from a check for transferring money, that it raises our alarm bells. So they're trying to use it for security purposes, but it does create nightmares on our end and therefore needs to be double checked. So now what happens if a client wants to use more than one account? Because you've seen that the 1040 provides space for a single account. Does that mean that the client can put their refund only into one account? Or that they have to put all of their refund into that one account? The answer is no. The IRS actually provides a system whereby they can divide their refund or split it between 2 accounts, or have the refund come partially as a check and partially as a direct deposit. It allows for that. So IRS has the form called 8888 that you can use if you want to have the IRS directly deposit your tax refund to either 2 or 3 of your accounts at a bank or financial institution, such as a mutual fund, brokerage firm, or credit union in the United States. If you file Form 8888, you can choose to get any part of your refund as a check as well. You cannot request a deposit of your refund into an account that is not in your name, such as your tax preparer's own account. Those are in the instructions for the Form 8888, but I can tell you right now that the IRS will send a refund to any account you enter on the form, whether it's the client's account or not. But the rules are that you are not supposed to, so as a tax practitioner, you shouldn't be consciously sending it to the wrong account. But if a client says to you, these are my account numbers, and in fact they are not their account numbers, the IRS will send it to those account numbers, which is another good reason to have your client sign off on it and verify it's correct. The account that you use can be a checking account, savings account, or any other account, such as an individual retirement account, IRA, or even a health savings account. Form 8888 can also be used to buy up to $5,000 of Series I savings bonds, but you cannot have your refund deposited into more than one account if you file Form 8379 Injured Spouse Allocation. Note also that if you want your refund deposited into only one account, do not complete this form. You should only use 8888 when you're dividing the refund between more than one account. So for Series I bonds, this is a relatively new feature. The IRS is trying to promote them for our government. You can invest part or all of your federal refund to buy Series I U.S. savings bonds, and you buy them in multiples of $50. Any amount of your refund not used to purchase the Series I bonds is issued to you as a refund, either by a paper check or by direct deposit to your bank account, depending on the method you choose when you fill out the form. You should receive your savings bonds about 3 weeks after you receive the remainder of your refund from the IRS. And here is Form 8888. You can see that there's space to enter up to 3 bank accounts. In Part 2, there's information to be entered about the person in whose name the Series I bonds will be issued. And then if you want to have any amount of the refund issued as a paper check, you would enter that information in Part 3. And finally, Part 4 is the total allocation of the refund. Part 4 is essentially a balance. You start with the full refund of the tax return. You then divide the refund up and how it's going to be issued. And when you get to the bottom line, all of the totals of how it will be issued should equal the total refund, not more or less. Refund offsets. Okay, so you have a refund, but something happened to it, and it wasn't because the tax preparer got the direct deposit information incorrect. The refund was just never released, and of course that happens all the time. It's called a refund offset, and that's the next topic of the day. Past due financial obligations can affect your current federal tax refund. The Department of the Treasury's Financial Management Service, or FMS, which issues IRS tax refunds, can use part or all of your federal tax refund to satisfy certain unpaid debts, including federal or state income taxes and child support or student loan debt that was submitted for offset. You will receive a notice if an offset occurs, and the notice will include the following information: your original refund amount, the offset amount, and the agency that received the payment and its contact information. If you believe you do not owe the debt, or you are disputing the amount taken from your refund, you need to contact the agency that the money was sent to, and not the IRS. The IRS is simply a middleman. They've been ordered through the FMS system to withhold that money and send it out. And once that money's gone, the IRS does not get it back. There's nothing that can be done to get the IRS to give you money that they sent to FMS. FMS is issuing it to the agency that's in the collection process, be it student loans or child support. And once it's there, it's between the taxpayer and that other third-party agency. Injured spouse allocation. Many federal offsets are applied to joint tax returns where only one spouse actually owes the IRS back taxes or the FMS debt. An injured spouse is an individual who files a joint return on Form 1040 and all or a part of the tax refund overpayment was or expected to be applied against a debt of one of the spouse's past due federal obligations, such as a federal tax account, a child or spousal support account, federal non-tax debt, or a state income tax obligation. An injured spouse can work to protect and receive his or her share of the joint overpayment when certain conditions are met, and he or she files Form 8379, which is the injured spouse allocation. Our firm fills out injured spouse allocations every year, and we've been doing so since I first became aware of the form about 20 years ago. So it's definitely not a new form. It's been around a long time. There was a period of time where it could not be electronically filed, but it now can be electronically filed. However, when you file the form, you can expect there will be a significant delay in the processing of your client's refund. Now, in order to qualify to use the form, the injured spouse must meet certain eligibility requirements, including a joint return must be filed and The injured spouse is not required to pay the past due debt amount, and the injured spouse has or will report income such as wages, taxable interest, unemployment compensation, etc., or the injured spouse will report payments such as federal income tax withholding from wages or estimated taxes, and if those don't apply, they are at least claiming the earned income credit or some other form of refundable credit. Form 8379, Injured Spouse Allocation. Let's take a look at the form and how it works. The form is used to apportion the following items between the injured and the non-injured spouse. These include income, deductions, dependents, tax credits, and withholdings. Form 8379 should be filed when the taxpayer becomes aware that part or all of their share of a refund overpayment was or expected to be applied or offset against their spouse's legally enforceable past due obligations. It needs to be filed each and every year the injured spouse meets the condition and wants their portion of the offset refunded to them. The IRS frequently receives Form 8379 incorrectly, and common incorrect filings of the form include: an individual files Form 8379 when he or she is not filing a married filing joint return. So in other words, 8379 should only be used when you're filing a joint return. A debt does not exist at either IRS or FMS, or the taxpayer owes a personal debt such as a utility bill. The IRS does not offset a refund because of a personal debt, so you shouldn't file 8379 for that reason. If Form 8379 is filed for an invalid reason, it delays issuance of a refund. Form 8379 was revised in January of 2010 to include a series of questions to assist taxpayers in determining whether the spouse is truly an injured spouse. It was revised again in November 2012 with just minor wording revisions. Filing Form 8379. Form 8379 can be filed in either of the following ways: with a jointly filed Form 1040 in either paper or electronic submission, or as a form separately filed after an offset has occurred. So you could have a client who files their tax return. You prepare it, you file it, and they come to you a few weeks later and say, hey, we never got a refund. So you help them go online and you see that based on the IRS's refund information available on their website for that client's return, that the IRS has used the refund to offset a debt. And you tell the client, well, the IRS has used your refund to offset a debt. And your client scratches his or her head, says, I don't owe any of that. And then you say, well, what about your spouse? Maybe it was for something of the spouse. So the client says, well, I know she's delinquent on some student loans, but why can they take my refund for that? Well, the reason the IRS took your refund is because you haven't asked for protection from the IRS to protect your share of the refund that's due to your spouse's debt. So you can actually file 8379 after the refund has actually been garnished. You can go ahead and send that form in, and the IRS will process it. And after a period of time, if it is determined that any part of the refund used for offset belongs to the injured spouse, then that portion of the refund will actually get released. So in order to distribute the refund overpayment to each spouse appropriately, the division of income payments and credits needs to be identified on the Form 8879, and to properly determine the amount of tax owed and the overpayment due to each spouse, an allocation must be made as if each spouse filed a married filing separate return instead of a joint return. Therefore, it's important that each spouse's wages, self-employment income, and expenses, including self-employment tax and credits such as education credits, are correctly identified on the appropriate columns. You complete Part 1 of the Form 8379 to determine if you are an injured spouse. Then you complete Part 2 of Form 8379 to tell the IRS which tax you are requesting relief for. And then in Part 3, you use the 3 columns that are in Part 3 to allocate income and deductions between yourself and the spouse. So the non-injured spouse and the injured spouse, all of those deduction credit income items are divided between them. And of course, here it says allow 8 to 14 weeks for IRS to process a tax return that has 8379 attached to it, so you can forget the normal 10-day window that most clients are able to receive the refund in. Now, I have had questions, and I already see it up. How does community property affect this, from Rebecca Balin? Thank you. I'm now at the point where we're actually going to talk about community property rules. Most of the country is not community property. I happen to live in Oregon. We're not a community property state, but we're surrounded by community property states here in Oregon. We've got Idaho to the east, Washington State to the north, and California to the south. And then, of course, Arizona is another community property state that's not that far off. So in Oregon, we really ought to be aware of community property rules. And if you happen to border a community property state, you should be aware of those rules as well. What happens in a community property state is a married couple, if you've got a housewife and you've got a husband who works, and say the husband earns $200,000, community property rules state that that husband's wage, 50% of it belongs to his wife. And even if they file separately, 50% of his income would be on her return, and it would be divided that way. So that's what it means to be community property, that all of the income and in many cases assets are considered to be community. It means they're shared. Thus, if a debt of one spouse is attributable to, say, child support, but the other spouse doesn't have that debt, you're going to have a division of community property income going on, even if only one spouse earned that money. But you still can use 8379 in a community property state. The complexity of the form actually goes up. You're going to have to look at community property laws and how they apply to your state. I would definitely be reading Publication 555, Community Property Rules, and the instructions for Form 8379 as I go. I don't have that kind of illustration in our manual today, but the provisions do allow for that. So the special rules do apply to the injured spouse refund calculation for taxpayers who are domiciled in community property states. In order to allocate the injured spouse's portion correctly, be sure to include the community property state where the taxpayers reside, and then you're going to need to divide all of the income items and the withholding items based on the community property rules for your state. Issuance of the injured spouse's refund. Part 2 of Form 8379 allows you to request that the injured spouse's portion of the refund be mailed to a different address. Since the information entered on Form 8379 does not change the address of record, requesting the injured spouse's portion be mailed to an address different than the address of record requires issuance of a manual refund, which will delay receipt of the refund. The IRS recommends that you file Form 8822 change of address rather than completing Part 2 of Form 8379 to help avoid a delay in the issuance of a refund. So here we have an illustration I created for completing an injured spouse allocation on Form 8379, and our characters in this story are Al and Peggy Bundy. Illinois is not a community property state as far as I recall, so we're not going to be dealing with any division of income there, and they reside in Illinois. They are a married couple with 2 children named Bud, age 13, and Kelly, age 10. Al works as a shoe salesman and received a W-2 reporting $30,000 of wage income for the year. Peggy is a homemaker and she had no income of her own. Peggy attended a hairdressing academy in 2007 and she incurred $5,000 of student loan debt. She has defaulted on her payments. During the year, she received a notification that her debt had been transferred to the FMS collection system and IRS would begin garnishing her refund. Al, understandably, does not want to see his hard-earned money used to pay Peggy's debt. So we're going to prepare the Bundy's Form 1040 and 8379 as shown next. But here we've got Al's tax return. You can see up at the top, my computer software typed injured spouse. As soon as I generated the 8379, the computer software slapped injured spouse up here on the header. And that just helps the IRS identify it as an injured spouse claim. There's going to be added complexity. We prepare the tax return as we normally would. $30,000 is the only income being reported on the return. But when we get over to the second page of the return, we can see that there has been some tax withholding for Al of $2,000. There's also a $3,609 earned income credit, and there's an additional child tax credit of $1,709. His tax is zero after claiming a child tax credit. So ultimately, we end up with a $7,318 refund. And it's safe to say that pretty much none of that refund is allocable to Peggy. There might be some amount of math going on in the fact that some of the standard deduction and one of the personal exemptions is hers. I've never actually seen how IRS does its calculations, nor have I had a client come to me and tell me how much refund they ultimately got. But you do use the injured spouse allocation to tell the IRS how you would like to see things broken up. And in Part 1 of the form, we're going to answer the questions, did you or will you file a joint return? The answer is yes for the Bundys. Did or will the IRS use that refund from that return to pay an offset amount? And in this case, it's going to be a federal non-tax debt such as a student loan. The answer is yes. Then, is Al legally obligated to pay this past due amount? Because Al is the injured spouse. We need to answer no, he is not on line 4. Were you a resident of a community property state at any time during the tax year? If yes, enter the name of the community property state and then complete the rest of the form. Al is not a resident of a community property state, so he checks no. Line 6, did you make and report payments such as federal tax withholding or estimated tax payments? Al answers yes, and so he's done. He doesn't need to go on. But if he answered no, then it would ask, is there earned income? It would ask, is there an earned income credit or a child tax credit? Are there any other refundable tax credits that he needs to protect? The answer is yes to all of those, but he doesn't need to answer those questions because he answered yes to the very first question, which is that he had federal income tax withholdings. Then in part 2 of the form, he identifies that he is the injured spouse. Peggy is not the injured spouse. You can see right here we've checked the box that Al is the injured spouse. And we've said no, we don't want to mail to a different address. Moving on to page 2 of the form, now we've got the division going on. And column A is the amount that is shown on the joint return. Column B would be what things would look like if Al filed married filing separately. Now, Al could file married filing separate, but he wouldn't want to because if he did, he'd lose his earned income credit. So filing separately is not a good idea. But all of the wage is attributable to Al, so we're going to give it all to Al. And then nothing would be allocated to Peggy. We move on down and we look at the standard deduction. Well, clearly, the standard deduction for married filing joint, half of that is attributable to each filer, so we're going to give half to Al, half to Peggy. Then we go down to the exemptions. And clearly it makes sense to give Al the exemptions for the 2 children. So we're going to do that. We're going to give him the exemptions. If he were to file separately, he would be claiming those kids. And the only exemption going to Peggy is her own. Then we have the credits, and this is the child tax credit. He's got 2 children under the age of 16. They are qualifying children. Each of them qualifies for a $1,000 child tax credit. That is the amount being entered on line 17, $2,000 for the 2 children, and all of it is being allocated to Al. Interestingly, it provides no space to enter his earned income credit. The IRS figures that on their own, and they do those calculations. They are not figured on the form itself. And then on line 19, we enter the federal tax payments. There was $2,000 of tax withheld from Al's wage, and all of it is going to apply to him. There is space at the bottom of the form for a signature. If the form is not being filed with the tax return, you would have the client sign it, and it would be mailed in as a paper document separate and apart from the form itself. But if it is a part of the federal return and it is being filed with the federal return, you do not sign it. All right, so let's move on to the next topic of the day, which is the amount you owe and what can you do about it. Because at some point we all have to pay Uncle Sam. Either we do it through withholding or we do it at the end, or we do it as estimated tax payments as we go. But at some point we have to pay that money in. If you owe a balance due with your return, you can pay the amount that you owe in any of the following ways. Firstly, by direct debit to your checking or savings account. You can actually submit a form with your tax return and ask the IRS to pull the money right out of your bank account. And that's a nice system because you can actually have it set up so that it comes out specifically on April 15th. So direct debit to your checking account is one of the ways that you can get your money delivered to the IRS, and it's a pretty easy, simple way to do it. I have lots of clients who like that method. Then there's also through the Electronic Federal Tax Payment System called EFTPS. And if you would like to apply for the ability to use that system, there's a link here inside the manual for that. Also, you can pay the amount you owe with a credit card, or you can do it the old-fashioned way. You can put your check or money order in the mail and send it off with a 1040V payment voucher. And so that's the first item we come to is 1040V. If you elect to pay your balance due by mail, and quite frankly, most of my clients do choose this method, IRS has Form 1040V, which is a statement that you send with your check or money order. Really, the purpose of the 1040V is to simply act like a statement, like a bill. When you pay your monthly power bill, you usually mail the check with the statement. It shows who you are, who the check's from. The amount on the check should match the 1040V amount, of course, and you send it in. It is possible to file a tax return electronically and have the 1040V follow up later on April 15th. That's what most of my clients do. It's also possible to file a paper return and put the 1040V in with the paper return. You can do that, or you could file a paper return separate from the 1040V and just mail the 1040V with the payment. There's no punishment or penalty if you don't use a 1040V, but the IRS prefers it if you do because it helps them process your tax amount or your tax payment more efficiently and make sure that it gets to the proper account. That is your account, not someone else's. EFTPS, I briefly mentioned that above. You can apply online using, or you can pay online using EFTPS. And to use EFTPS, you must have an account. So you will need to create an account, and you do so at the URL you see here. When you set up the account, you will need to provide routing and account numbers for the financial account that you will be using to make payments. The IRS will process your application and send you a PIN notice in the mail. When you get the PIN notice, you use the PIN that you get from the IRS to actually activate your account. Once activated, you can schedule tax payments 2 days to 120 days into the future. And I did a cutout from the IRS's website of their EFTPS information. They say it's the easiest way to pay all of your federal taxes, and I can testify that it is a very good, efficient system. Our company uses it all the time to pay our own payroll taxes, as well as the payroll taxes for our clients that we do payroll for. But individuals can use it also. You can go into EFTPS and create an account that you simply use to make your estimated tax payments or to make your federal balance due payments. And it is a fast, efficient system to use. I can definitely vouch for that. The IRS does not have a system in place where you can go to their website on April 15th and figure out how to pay your balance due through direct debit. They don't work that way. You can request direct debit at the time you file your return, but you can't do it after the return is filed except through EFTPS. But some states do have a system where you can log on to the state website on April 15th, enter the information off your checkbook, and have the money come out of your checking account. The IRS doesn't do it that way. You have to have the EFTPS account first, and that does take time to set up. Also, once you have the account set up, you do need to initiate deposit, usually about 2 days before the payment is due to go out. But you can also go into EFTPS and set the payment up well ahead of time. You might file your tax return on February 15th and want EFTPS to pay out to IRS on April 14th or April 15th, and you would be able to set it up so that it automatically would do that on the appropriate date, and you wouldn't have to remember to go back as the time was approaching. Now, another way to pay your debt is by credit card. You can pay by debit or credit card, by internet or over the phone. Note that debit or credit card payments cannot usually be canceled, so once you initiate the process, you're stuck with it. The other thing is that although the IRS promotes payment by credit card, it does cost your client more money. If your client owes the IRS $10,000 and they charge that to their credit card, it's going to cost them a bit of money, probably a couple $100. Firstly, you can see there's a $3.95 debit card fee that they have to pay, and then there's an interest rate. So why the interest rate? What's that about? Well, the IRS actually doesn't get that money. The money that is going out in the form of that interest charge goes to the credit card company. You're borrowing money from that credit card company, and they charge you for it. And so it's an interest rate being charged on the loan that you are taking out from the credit card company. Even if you pay your credit card off immediately without incurring any other interest rate charges on it, you're always going to be assessed that minimum fee. Now, there are about 5 different companies currently available on the IRS's website or being offered on the IRS's website as being choices that you can utilize for making payment by credit card, and they all have differing rates. And you can see that PayUSA offers probably the most choices for different types of credit cards that you might have available to you. And it also has one of the lowest overall rates. Up here, Choice Pay also has a lower rate, but it only accepts Visa and MasterCard. What about options for those filers who can't afford to pay at all? They can't afford to pay by credit card. They can't afford to pay because they have the cash in the bank. They can't afford to pay. What do? And as I commented at the start of this particular session, our clients, when they come to us, they want to know the information I'm about to give you. This information that you're absorbing right now can be a win-win between you and your client. The knowledge that you have can ease them through a financial crisis that they may be feeling incredibly stressed out about, and how you help them through that can impact them for many years to come in very significant emotional ways that we may not even be aware of. So having the information handy and available anytime you need to give it to a client can be very beneficial for your business. So options for filers who cannot pay. Your balance due is subject to interest and a monthly late payment penalty if you do not pay by the due date of your return, not including extensions. And penalties are also assessed for failure to file a tax return. Therefore, you should file immediately, even if you cannot pay your balance due in full. And a lot of clients, they say, I can't afford to pay, so I'm not going to file. Or I can't afford to pay, so I'm going to file an extension, and hopefully by October I have enough money to pay. There's a lot of that goes on mentally in the mind of the client, and they may not be voicing it to us. They may be calling up and saying, yeah, I need to file for an extension this year. And so one of the questions I ask is, well, why are you filing for an extension? And then the answer is, if it is, I can't afford to pay. And then I say, well, do you understand that the extension is not an extension of time to pay? If you can't afford to pay, you're probably better off just figuring out what you owe, filing the return, and asking for one of the installment plans or the different methods that the IRS has in place to help you pay over time. That's the best advice that you could give a client, rather than the head in the sand technique, which is I'll pretend I don't owe it and hope they don't notice. Because believe me, they always do eventually notice. So let's look at the options available. The first one is the Installment Agreement Form 9465. This has been around a long time. I fill it out several times every tax season for numerous clients, more than I can count. The 9465 can be submitted electronically with the tax return. It can be submitted electronically separate from the tax return. It can also be mailed in paper, and you can even implement it and get it going over the phone with the IRS. They're pretty flexible as long as you're asking for relief, asking for a plan to be put in place, trying to work with them so that you are making payments. They're pretty relaxed and systematic about how they go about doing that. So if you cannot afford to pay the full amount due with your return, you can ask to make monthly installment payments for the full or a partial amount. Interest and late payment penalties are charged by the IRS until such time as the amount owed is paid in full. But typically they are far less when you have a 9465 in place than if you simply don't file or don't pay. So the 9465 can reduce your late payment penalties. You are better off by far filing Form 9465 and mailing it with your timely filed return than you are if you either don't file at all or file an extension and then don't pay your tax. To ask for an installment agreement, use Form 9465, and you should receive a response from the IRS with regards to your request within 30 days. But if you do refile your return after March 31st, it can take longer than 30 days simply because most people who owe wait until the last 2 weeks of tax season, right? So they're going to get all of these installment requests in at the same time and have to process them. You can submit 9465 with your return. You can file it as a separate document. You can file it paper or electronically. If you owe less than $50,000, you may be able to establish an installment agreement online, even if you have not yet received a bill for your taxes. And I have had 1 or 2 clients take advantage of this. A couple of years ago, I had a client who, when I prepared her tax return, she was going to owe the IRS. She owned a business, S corporation, K-1 income flowing through to her personal return, and she had a profit that year, and ouch, she owed a lot of money. But she didn't have it because all of her money is always just churning around in this company. But she knew that she'd probably have it when some account payments came in later in the year. So for her, we did the online installment agreement, and she was given the 120 days extra time to pay. So that worked nicely for her. So if you owe less than $50,000, you may be able to establish your payment agreement online. And in certain cases, you can avoid some of these fees here because there is an online payment agreement that if you pay it within a certain period of time, you don't get charged these fees. Now, if you owe more than $50,000, you can still ask for an installment agreement, but now the IRS wants you to fill out an application. It's a Form 433, and this form is essentially disclosure of all of your assets, your income, your expenses, to essentially establish how much money you really have available. And at that point, they have to do a manual review and approve the application. It's not an automatic thing. A user fee does apply. So if you are recommending that your client submit 9465 with the return, you should be aware of these user fees. If you ask for an installment agreement where you're going to be making payments by check, money order, or credit card, there's an application fee of $105. If you're submitting 9465 and you're providing information for your bank account so that direct debit to the account can occur each month on the payment due date, then the fee drops to $52. And if you ask for payments to be made through a payroll deduction, then the fee is $105. Well, I take this into account. If I have a client that owes $1,000 with their tax return, but they don't have the money to send, but they will have it in a couple of months, well, the late payment penalty would be less than the application fee. So to those people, I say, hey, you know what? Let them give you the late payment penalty, because the late payment penalty is going to be less than the application fee as long as you have the money sent in on time. Or maybe they even only owe $500. So you have to be kind of figuring mentally where they're at. Perhaps they're better off not asking for this $94.65, or maybe they're better off asking for one of the other options available that we're going to come up across next. Now, certain people may qualify for a reduced fee of $43 if their income is below 250% of the federal poverty limit based on their household size. So if you have a client who is lower income, the IRS won't charge them $105, they'll charge them $43, and it's fairly much an automatic thing. The IRS knows how much they made based on their tax return. But if you feel that they qualify for the lower rate and the IRS didn't give it to them, then you can request the lower fee with Form 13844. Now, sometimes, not too infrequently, mind you, taxpayers default on their installment agreements. Or it could be the case that they're on an installment agreement, but now they owe for the next year and they don't have the money to pay for the next year, so they have to add 2 years together. In those situations, the IRS has a restructuring or reinstatement fee that it charges, which is $45, and there's no grace on that based on income. It's $45 to everyone who falls into that category. Guaranteed availability of the installment agreement. The IRS is required under the law to agree to accept the full payment of your tax liability in installments if, as of the date that you make the offer to enter into the agreement, the total taxes, not counting interest, penalty, additions to the tax or additional amounts, do not exceed $10,000. And in the last 5 years, you and your spouse, if the liability relates to a joint return, have not failed to file any required tax return, have not failed to pay any tax shown on any such return, or entered into an installment agreement for any tax. So if you have a client who owes $10,000 or less, they've never had an installment agreement in the past, all of their tax returns for prior years are up to date, this is the 1 year that's a problem, the installment agreement will automatically be accepted. Now, my experience is that IRS virtually accepts every installment agreement that I've ever submitted anyway, but these are the criteria under which it's guaranteed that they will accept it. You need to be able to show that you cannot pay your income tax full when it's due. The tax will be paid in 3 years or less, and you agree to comply with the tax laws while your agreement is in effect. So very often my clients are saying to me, well, how long do I have? And I typically say, well, as long as you need. You know, you want to be able to pay it off within 3 years typically. You can go longer, but if you go longer, then the IRS is going to continue to charge interest over and over, increased amounts of interest and penalties over time, and it's possible they'll turn down the installment agreement. So I typically take the balance due, I figure a certain amount of interest accumulating over time, and come up with a reasonable minimum monthly amount based on their income and the amount that they owe. Now, once the IRS agrees to set up an installment plan for you, you can expect to receive a monthly bill. You must make each payment on time or the payment will be rescinded. And regarding making payments, you do, on the Form 9465, need to specify the amount that you can pay and the day of the month, anywhere between the 1st and the 28th of the month, on which you wish to make your payment each month. The IRS will expect to receive the payment on that date. Therefore, you need to figure the mailing time into the date that you select. So if your client says, yeah, I want to make the payment on the 28th of the month because that's when I get paid, well, then maybe they should select the 3rd of the month so that when they mail it on the 28th, it will be in IRS's hands by the 3rd, you see? Or if they get paid on the 15th, then maybe they could afford to have a payment for the 20th. So they want to make sure they have the money available 3 to 4 days before they mail that check out to the IRS. Payroll deduction agreement. You can choose to make an installment payment by initiating a payroll deduction installment agreement. To make the election, Form 2159 must be filed by your employer. So you would need to go to your employer and say, yeah, boss, I want to have extra money held out of my paycheck each month to pay what I owe the IRS. The employer needs to submit Form 2159, and the employer is responsible for doing that extra withholding and then sending the money in. This is the Form 9465 itself, and you can see it asks for the name and address of the filer. It wants contact information. It wants the information from your bank account if the filer is willing to release that information. Most of my clients don't want the IRS to know what their bank account information is. However, ultimately, if the IRS goes into tax collections and liens, it will get to their bank account one way or another anyway. But if they do want direct deposit, then you need to provide the financial account information, including, again, the routing number and the account number. If the form is being mailed in separate from the return, the client needs to sign it. If it's not being mailed in separate from the return, it does not need to be signed. The next one we're going to talk about is the online payment agreement, and it's an excellent option for people who can pay their money within a certain period of time. They don't need as much time. You may be able to apply online for a payment agreement if you owe federal tax, interest, and penalties, and if you have received a balance due notice from the IRS and you cannot pay your amount in full, you can request the payment agreement. The OPA application allows you or your authorized representative to self-qualify for and apply for a payment agreement, receive the notification of approval, and arrange a payment schedule. So the beauty of this system, there's multiple features to it. One is the tax client can go online themselves and fill it out, or they can authorize you as their representative to go do it for them. So that would be a nice service that you could provide. And then if the online payment application is approved, then it's automatic. You can see it right there. The IRS will tell you that it's been approved, and basically at that point it's implemented. To use the OPA application, you must have filed all required tax returns. You should also have the following information available: the balance due notice from the IRS, the Social Security number or individual tax identification number of the filer, the personal identification number, which can be established online using the caller identification number from the balance due notice. So essentially, to use the online payment system, you can't use it until the IRS has acknowledged that there's a debt. So the return has to get filed, the debt is outstanding, the debt needs to be paid. Now you can go online and fill out the application. But you can't fill out the application until the IRS has accepted the tax return and acknowledged that there's a debt. Online payment agreement requirements. Taxpayers must meet these requirements before they can apply online. Only individual taxpayers, those that owe income taxes from Form 1040, can apply by using a payment plan online. All of your tax returns must be filed. So if you haven't filed for a few years, you have to do that first. The total balance due, including any assessed penalties and interest, must be $50,000 or less. If you owe between $25,000 and $50,000, you have to sign up for a direct debit payment agreement where your monthly payments are automatically deducted from your bank account, and you must be able to pay off your taxes in full in 72 months, that is 6 years or less. Filers who owe more than $50,000, you may still qualify for installments, but you won't be able to use the online system to apply. How do you make an application using OPA? Well, you make your application by following the URL link I inserted here, and you follow the instructions that will pop up. I essentially captured images of the pages that you land on the IRS website, and it provides information about who can use the system. It says, firstly, determine your eligibility. If you owe $50,000 or less in combined tax, penalties, and interest, and you have filed all required tax returns, you're eligible. You then need to gather all of the necessary information: the Social Security number, the date of birth, the caller ID number shown on the top of your recent notice, the PIN if you have one. If not, you need your AGI, bank address, employer address, the highest amount you can pay, and when you can pay it each month, and then you have to have your tax return handy to verify the information. You need to submit your application by applying for a payment agreement. You will receive immediate notification of approval, and you also have to consider system availability. You can't apply online when the system is closed, so they give you the hours of availability there. And with the IRS closures because of the government shutdowns, because of the budget fights, they may not be available on certain days of the year. Online payment agreement, when you do go through and submit, yeah, I'm ready to apply, there's actually a link that you click on, this apply for payment on the site. And when you click on it, this is the first page you land on, and it says my status. Confirm your present status by selecting one option. I am the taxpayer. I have filed a return and received a notice. Or I am a taxpayer. I filed a return and have not received a notice. Or my return has been examined and I owe tax. The taxpayer would select one of those options. But if you're preparing or you're filing for this under a power of attorney for your client, then you would check all of the box that is appropriate for you doing it as an agent for your client. And then the next page it takes you to is this page where you start to enter information about the client. And I entered information relating to the tax practitioner because it asks for your CAF number and information if you're going to do this for your client. Clearly, if the client was doing it themselves, they would get a different page. Partial payment installment agreement. The IRS has an additional payment option for taxpayers who have outstanding federal tax liabilities. The Partial Payment Installment Agreement Plan option is available for taxpayers who are unlikely to be able to pay their taxes in full, and it is an alternative to filing for an offer in compromise. The offer in compromise system is complex and difficult to qualify under, but some filers do qualify under offer in compromise, and if they do, it can be a really good way to get relief, full relief from a tax debt that they owe. But not everyone can qualify for an offer in compromise, and if that's the case, this partial payment installment agreement plan can be a way around that. Firstly, though, if you're going to qualify, you're going to have to submit all of your financial information. You need to provide a complete and accurate financial information that is going to be reviewed by the IRS and verified. You will also be required to address equity that you have in assets that might be used to reduce or pay the amount that you actually owe. Your installment plan will be reviewed every 2 years. If you are granted a PPIA, you will be subject to a subsequent financial review every other year. After each review, the amount of the installment payments could increase or the agreement could be terminated if your financial condition has improved. The IRS will still look at realizable value of your assets and your ability to make monthly payments. Applying for a PPIA. To apply for the PPIA, you have to fill out Form 433A or Form 33B. These forms are essentially asset forms. They show what assets you have, any equity that you have. They show the liabilities that you have. They show your monthly income, your monthly expenses, and your actual ability to pay. And if your monthly living expenses exceed threshold amounts, you may still be expected to pay. But in most cases, the IRS offers reasonably generous threshold amounts for living expenses. And if your income minus taxes is less than those expenses, it may be you won't be required to make any payments at all. Now, if you have assets that can be sold, the IRS may ask you to sell those to pay what tax you can. And if your assets have that kind of value, it's possible that you will be required to sell it. But if there's no value in the assets because they're not sellable, for example, maybe you have a house, but market conditions for the house make it such that the house would be difficult to sell, or if it did sell, the mortgage you have on it is such that by the time it was sold, you'd have almost nothing left, they're not going to make you sell it. Similarly, for cars, you're allowed to retain a certain amount of equity in a car before you'd be required to sell it. So sale of assets. You may have assets that are necessary to allow you to earn income and make payments. The payments may generate more income for the government than the sale of the assets would. If the sale of an asset would cause an economic hardship and you would not be able to meet reasonable living needs because of that hardship, then the sale will not be required. For example, maybe you have a car worth $4,000, you own it free and clear. The IRS could potentially make you sell it, but if they make you sell it, how would you get to work? That would be an economic hardship for you. So they probably wouldn't require that sale. Uncollectible status. If your income is currently too low to be able to afford to make any payments at all to the IRS, you can request the IRS put your account into uncollectible status. The account will be reviewed every 2 years, and at that time, the IRS can increase the payment requirement or terminate the agreement. And I was actually told by an IRS agent over the phone a number of years ago when I applied for a partial payment installment agreement for a client that after 10 years in a partial payment status or in uncollectible status, the IRS would actually write the debt off, that because they have only 10 years to collect on that debt. Now, in the case of the client I had, he was a real estate agent, and this was 2008. It was the bottom of the market. He was destitute. And so he went into this partial payment installment plan where he was essentially put in uncollectible status, and they're not making any efforts to collect. But since then, his income has risen dramatically, and it is likely the case on a review they are going to ask that he start to make payments, which I think he will happily do. So let's now take a look at another form. This is the innocent spouse form. And the rules for innocent spouse are completely different than the rules for injured spouse. I haven't even put them next to each other in the manual because they belong in different places. The injured spouse form is used when you have a refund. You want to protect that refund. The innocent spouse form is used when you owe tax, or at least your spouse owes some tax, but the IRS is trying to get that money out of you. And you don't believe you owe it or that it would be unfair that you should have to pay it. And so the innocent spouse procedures are for stopping IRS collection against you, whereas the injured spouse form is to protect the issuance of a refund to you. So hopefully you can see there's a very distinct difference there. Now, in certain situations, the IRS may commence collection procedures against a taxpayer for tax debts that are owed by the taxpayer's spouse or a former spouse. If the IRS is attempting to collect taxes which you believe you do not owe, you may qualify for innocent spouse relief. Firstly, let's talk about this concept of joint and several liability. It's a term that you should understand because the IRS mentions it in its rules. It's kind of a legal term. When you file a joint tax return, the law makes both you and your spouse responsible for the entire tax liability shown on the return. This is called joint and several liability. The joint and several liability rule would be a key reason why a filer may choose to file separately, even if it causes them to have a greater tax liability than if they were to file jointly. So let's just suppose you've got Jack and Jill. They're filing a joint return, and if they file jointly, the tax liability is $10,000. But if they file separately, Jill's liability would be $4,000 and Jack's liability would be $15,000. Well, Jill's not so trusting of Jack. She's concerned that if she files a joint return, the IRS might come after her for the $10,000 because he may not pay it. So she says, I'm going to file separately. I'm going to pay the $4,000 rather than file a joint return where the two of us as a couple can only owe $10,000. And Jack's left out there in the cold where if you file separately, I'm going to owe $15,000 instead of a shared liability of $10,000. I don't like that deal at all. But that's Jill's prerogative. She can file separately as a way to protect herself. And if she feels in any way threatened by the relationship she has with Jack in that he may not be good for his money or the tax debt owed, then she'd be smart to do that. But every once in a while, filers are in a situation where they file joint returns, and in hindsight, they shouldn't have. And sometimes relief is available through the innocent spouse form, sometimes it's not. So when you do sign that joint return with your spouse, you're responsible for all of the tax owed on that return, even if you're not responsible for the income that generated that tax. And this term is called joint and several liability. Joint and several liability applies to the tax liability you show on the tax return, and it also applies to any additional tax liability the IRS determines to be due, even if the additional tax is due to income deductions or credits of your spouse or former spouse. Now, very often there's a divorce decree in place, and the divorce decree will say something like this. All of the prior year back taxes owed by the married couple are now going to be attributable to the wife, and she accepts full responsibility for paying those taxes. The divorce decree can say that, but it doesn't mean that the IRS will recognize that the husband no longer owes the tax. If there's a joint and several liability on the return, even if the divorce decree orders the wife to pay it, the IRS can still attempt to collect off the husband. So the divorce decree cannot supersede the law in that respect. You remain jointly and severally liable for taxes, and IRS can still collect from you, even if you later divorce and the divorce decree states that your former spouse will be solely responsible for the tax. Now, there is an exception for a spouse who was abused or lacked financial control. In Notice 2012-8, the IRS announced that it will use proposed new procedures that will expand how the IRS will take into account abuse and financial control by the non-requesting spouse in determining whether equitable relief is warranted. Innocent spouse relief may now be granted in cases where a taxpayer signed a joint return but did so because they were abused or lacked financial control. Relief from tax debts of the spouse or former spouse. Tax laws state that both spouses are jointly and severally liable for taxes owed on a joint return, but that in certain situations, one spouse may request relief from the tax debts owed by a joint return or on a joint return. In some cases, a spouse or former spouse will be relieved of the tax, interest, and penalties on a joint return. There are three types of relief that are available to married persons who file joint returns. The first is innocent spouse relief. The second is separation of liability relief, and the third is equitable relief. Married persons who did not file joint returns but who live in community property states may also qualify for relief. You must request relief within 2 years after the date on which the IRS first began collection activity against you after July 22, 1998. You may qualify for innocent spouse relief if you signed a joint return and the IRS has determined that tax is owed on the joint return because the return showed tax was due but it wasn't paid, or the IRS has amended a return that understated the amount of tax owed, and you can show that the understated tax is due to erroneous items of your spouse or former spouse and not you, that at the time you signed the joint return, you did not know and had no reason to know that there was an understatement of tax, and taking into account all of the facts and circumstances, it would be unfair to hold you liable for that understated tax. Erroneous items are any deductions, credits, withholdings, or payments that are incorrectly restated on the return, and any income that is not properly reported on the return. Well, very early on in my career, I ended up preparing an injured spouse claim for a client. This was so early on in my career, they didn't even have a form to do it. I essentially had a woman who came to me. I did a return. She was a school teacher. She was a single mom. We filed her head of household. She was married, but her spouse had abandoned her a couple, 3 years earlier and was nowhere on the scene. But she qualified for some good deductions because she was a single mom. She was paying a mortgage all on her own, and she had a nice refund coming. But the refund never came. The IRS took it. And so when she came in to say, I've never gotten my money, April, what happened to it? I got on the phone with her and we called the IRS, and we were able to figure out that they had taken her refund to pay taxes owed on an earlier year's return that she had filed with her husband. And what had happened on that former year's return is that all of her income was fully disclosed. She was a school teacher. She had a W-2. That was disclosed on the return. But her husband had fishing income, significant amount of fishing income issued on a 1099 miscellaneous, and he had never put that on the return. So it wasn't reported on the return. And subsequent to the filing of the return, the IRS obviously audited it, amended it, and added tax on there. And now they were collecting from her because basically he was a dirtball and he wasn't filing returns at all. He wasn't paying child support. He wasn't helping out in any way, and he wasn't paying his taxes. And now the IRS was coming to her for it. And so it was there and then on the phone that the IRS told me that we needed to submit a letter explaining the situation. We needed at the top of the letter to write injured spouse claim. And ultimately, as a result of that, the IRS did release her refund and made no further effort to collect on her. So that's a perfect example of how the innocent spouse provisions can work to benefit your filer. Now, in the years that have passed since I did that claim for my client, the IRS has actually come out with a proper form, and it goes through a questionnaire at the top to find out whether or not you even qualify for the form, whether community property rules will apply to you. It says, tell us about yourself, tell us about your spouse, then go on and provide the filing status that you used in all of the earlier years, and how were you involved with the finances and the decisions that revolved around the filing of the joint return on which collection measures are being placed, and so on. And if, as a result of all of the information you provide to the IRS on the injured spouse claim, the IRS is able to determine that you have an injured spouse situation, then they will not force the injured spouse to pay amounts owed by the other spouse. So again, just comparing the injured spouse to the innocent spouse relief, the IRS does have filers who get these two situations confused all the time. And as a result of that, I felt it would be good to point out again what the differences are. Well, similar in name, innocent spouse and injured spouse provisions have very different applications. Thus, it is helpful to remember that an injured spouse claim is filed on Form 8379, and it is used to protect the refund due on a joint tax return for the year that the IRS is garnishing to pay FMS or back taxes or whatever. One spouse doesn't owe the debt, the other spouse does, and the refund of one spouse is being used to pay the debt of another spouse. And it has nothing to do with the debt on the current return being filed. It has its external debt. Whereas an innocent spouse form, 8557, is filed to stop IRS collection procedures for tax owed on a joint return that was filed in an earlier year. So as a reminder, again, injured spouse relief applies when a married couple files a joint return with a claim for a refund and one spouse, that is the non-injured spouse, owes a debt to the IRS or another agency that is being collected on through FMS, and the other spouse, the injured spouse, does not have the debt with the IRS or the other agency, and therefore would be receiving their refund if their non-injured spouse weren't causing them problems. And the refund shown on the joint return is due at least in part to the injured spouse. and the injured spouse's refund will be used to pay the debt of the non-injured spouse. So all of those are reasons why you would file injured spouse. An innocent spouse is a completely different situation. Next topic we're going to look at today is estimated taxes. The law imposes penalties and interest on filers who pay their taxes late. And while it is possible to pay your taxes at the time you file your return, you can be penalized if you owe more than a certain amount when you file. So who must pay estimated tax? Well, estimated tax rules apply to U.S. citizens and resident aliens. They also apply to residents of Puerto Rico, in the Virgin Islands, Guam, the Commonwealth of the Northern Mariana Islands, and also non-resident aliens who are filing 1040-NR. They need to pay those using 1040-ES-NR. There is an exception. You do not have to pay 2012 estimated tax if you were a U.S. citizen or resident alien for all of 2011, that is the earlier year, and you had no liability in that earlier year for that full 12-month period. So if you go back and look at your client's 2012 tax return, you can see their liability was zero. They are not required to make estimated tax payments in 2012 regardless of their income. In most cases, you must make estimated tax payments in 2012 if you expect to owe at least $1,000 in 2012 after subtracting your withholdings and credits, and you expect your withholding and credit to be less than the smaller of 90% of the tax shown on your 2012 return or 100% of the tax shown on your 2011 return. And if your AGI is $150,000 or more, then you have to pay in at least 110% of the amount shown on your 2011 return or 90% of the amount shown on your 2012 return. Now, what about withholdings? How do those play into the estimated tax rules? Well, if you are an employee, you may be able to avoid having to pay estimated tax by having your employer withhold income taxes from your pay. Even if you do not have your taxes withheld evenly throughout the year, you will avoid the penalty for underpayment of tax by having the minimum required amount withheld from your pay by the end of the year. So let's see how that would work. We have an illustration where we have a filer who does a large year-end catch-up on his withholdings. Sam works for ABC Company, and during the year he was short on cash. So he asked his employer to stop withholding taxes from his pay so he could have some extra take-home each month to kind of catch up on some financial needs he has. But beginning in October, Sam got his life back in order, and he says, okay, I need to get some extra withholding going on because I don't want to owe a bunch of money at the end of the year and get an estimated tax penalty. So he goes to his employer and he says, you know, I want you to withhold an extra $300 every paycheck between now and the end of the year so that I don't owe more than $1,000 at the time I file. And if that works, if by the end of the year he is caught up, then he won't owe an estimated tax payment penalty, even though all of his payments through withholding were unequal throughout the year. And you could, in effect, say that Sam borrowed from the money early on by reducing his withholdings, and later on he repaid, but he's not going to have to pay any interest on that loan that he took out. Now, there are some special rules with regards to the amount of estimated tax that needs to be paid if you are a farmer or a fisherman. If at least 2/3 of your gross income is from farming or fishing, you may do one of the following with regards to estimated tax payments. You do not have to pay estimated tax at all if you file your 2012 tax return and pay all of the tax due by March 1 of 2013. So the normal filer's return is due April 15. If you're a farmer and you file by March 1st and pay all of your tax by March 1st, you can go the entire 2012 year and pay no tax at all. Just figure out what it is that you owe and pay it when you file on March 1st. You're clean, you're good to go. You do not have to pay estimated tax as a farmer or fisherman if you expect your 2012 income tax withholding to be at least 66.23%, or in 2/3%, 0.667 of the total tax to be shown on your 2012 return, or 100% of the tax shown on your 2011 return. If you must pay estimated tax, you are required to make only one estimated tax payment. You required annual payment, and you make it by January 15, 2013, using special rules to figure the amount. So farmers and fishermen clearly are getting a special break here. The rest of us aren't so lucky. If you are not a farmer or a fisherman and you owe estimated tax payments, you need to pay them on time every quarter, and this is how it works. And again, we're looking at 2012 estimated tax payments and when they were due, not the 2013 year that we're in now. So for 2012, The first estimated tax payment for 2012 was due on April 17, and then subsequent payments were due on June 15, September 17, and January 15 of 2013. So the final payment for 2012 was due in 2013. And please note that I've got a little asterisk here next to April 17th. If the tax payment deadline falls on a weekend or holiday, the payment date is stretched out to the next business day. And this is similar to what we see with April 15th falling on a weekend. If it does, you push it out until you get to the next business day. And it's the same rule that applies to estimated tax payments. Now, what if I forget how much estimated tax I paid? Does it ever happen to you that you have a client come in that they say they made estimated tax payments, but they're not sure how much or when they paid them? I get that all the time. I also get clients who tell me estimated tax payment dates and the amounts they give me are wrong. And unfortunately, inevitably, if the estimated tax amounts that I enter on a tax return are incorrect, there's a 100% probability that the IRS is going to figure out that they're incorrect, because the IRS knows exactly how much money it got from the filer and when it got it. And so if there's a mismatch between what they got and what is on the tax return, it's going to come up. And invariably, though, unfortunately, the filer, the tax client, is going to blame me if the estimated tax amount on the return is wrong. So I can't enter any estimated amount on the return other than what they tell me or what they provide to me in their written records. And if those records are wrong, the tax return is wrong. So it's kind of a no-win situation there. I get blamed when there's a problem, whether it's my fault or not. So what can you do to help minimize this problem? Well, you should ask your client for the canceled checks that they have for the estimated tax payments they made. If they don't have that, did they keep a check register where they show the amount that they paid on each date? If they didn't keep that, did you give them payment vouchers for estimated tax, and did they kind of retain one part of the estimated voucher where they wrote down the date that they paid it and the amount that they paid? If they didn't have that, how did they keep track of it? Did they just write it down on a sheet of paper, how much they remember sending in? Are they bringing in a bank statement and circling the amounts that they said that they sent in? How are they determining those amounts? Well, one of the things you have to remember is that if you have a tax payment that is due, let's just say we'll go forward in time to the current year, 2013, you're filing your client's 2012 return, and you're filing it on April 15, 2013. Happens to be that the very first estimated tax payment for 2013 is also due on April 15th. So if you go back in time a year ago and you think, okay, on April 17, 2012, my client filed their 2011 return and paid what they owed with their 2011 return on April 17. And on that same day, they also owed the first quarterly installment payment for 2012. So if you're seeing that a payment went out on April 15th, was that payment for the earlier year's return? Well, one of the things I'll look at is, okay, here's a payment that went out. It was $800. Oh, $800 is exactly what they owed with their 2011 return. So it probably wasn't estimated tax. So where is their estimated tax payment? Do I see any other payment on April 17th that could possibly be an estimated tax payment? Because if I don't, I have no way to know that there was one. And do they have any information that they can give me that there was one? If they don't, then where do I turn? The answer is I call the IRS. And you can call the IRS at the number you see on your screen here, which is basically the 800-829-1040 number. A tax client themselves can call that number, and the IRS will tell them how much estimated tax was received and the dates that that money was received on. And quite frankly, it can be worth that phone call and the time taken to make that phone call to avoid having a situation where the wrong estimated tax amount is put on the tax return. So here is an example. We have a little old lady named Janice. She's 70 years old, and she doesn't know much about her finances at all. She wrote a bunch of checks to the government, and now you are her tax preparer. She's bringing in the canceled checks or the estimated tax payment amounts, and she's telling you this is what I paid. She says on January 5th, 2012, I made a $500 payment. And then on April 10th, 2012, I made a payment for $550, and I paid another $550 on June 15th, $550 on September 6th, and $550 on January 10th of 2013. Well, how much of this tax is attributable to 2012? Well, the amount attributable to 2012 is the April 10th through January 10th, 2013 payments. This payment up here for January 5, 2012, that is going to automatically have been applied to the 2011 tax year by the IRS. So you better not be putting this one on the 2012 return. So I say watch out for that January payment and stick it where it belongs. The reason I say that is because I have watched tax preparers take the 2011 payment and put it on the 2012 return on a year-by-year basis countless times over the past 20 years. It's just a constant thing I see all the time. Here is an example. Taxpayer provides inaccurate payment information. Mr. H made payments during 2012. He wrote the date and amount of each payment in his check register. In April 2013, Mr. H asks you to prepare his tax return. He tells you he made 4 payments to the IRS in the amount of $400. Watch out. If Mr. H did not provide the correct information on his payments, the amount you enter on the 1040 will be wrong, and wherever possible, you should ask that client to provide you with some kind of documentation that shows the amount and date of each payment that they made. Figuring the amount of estimated tax to pay. Calculating the correct amount of estimated tax payment can be tricky. The IRS does provide an estimated tax worksheet, which can be helpful, but I don't like it personally. That's why I don't have it in the manual here. I don't fill it out. I don't use it. I don't like it. It makes something that should be quite simple too complicated if you ask me. Here's the system I use. You calculate your estimated taxes manually as follows. Figure your approximate income and deductions for the coming year. So in other words, I've just finished preparing my client's 2012 return. What's 2013 going to look like? Is the income going to go up? Are the deductions going to go down? Are they going to have a baby? Are they going to have a kid grow up and leave home? Is someone going to go to college? Is things going to be similar, or are they going to be different? And to the extent that they're different, what will their tax return look like a year from now? And look at the bottom line on there. What will their tax liability be on their tax return a year from now? If you're smart enough about doing tax returns, you should be able to figure that out. Then you look at the amount of tax that they expect to have withheld from their paycheck throughout 2013. And based on what they think will be withheld from their pay throughout 2013, you compare that withholding to the amount of tax liability that they're going to have on the made-up return for the coming year. And if you see that they're going to owe less than $1,000 based on those criteria, then they don't really need to make estimated tax payments. But if you see that they're going to owe more than $1,000, then you take what it is you think that they're going to owe, divide that by 4, and you've got the amount of the installment payments they are supposed to make. Now, why do I use this formula rather than look at the last year liability and divide that by 4 and come up with an estimated amount? Well, the liability for the earlier year divided by 4 is only valid if they don't have withholding. And any other system you come up with is only going to be valid assuming you have exact numbers. And you never have exact numbers till the year is over, do you? So the best thing you can do is projection. But no matter what, you should always be looking at how much tax they expect to have withheld this year. Let's just say your filer earned $100,000 in the earlier year, say 2012. And they're looking forward to 2013 and trying to decide whether or not they need to make estimated tax payments. Well, if for 2013, their income is also going to be $100,000, but their withholding is going to be increased to such a point that it pays an amount equal to last year's liability, then they don't need to make estimated tax payments. So you always need to figure in there how much they're earning, how much they're having withheld. And again, I always return to let's just do a dummy return, kind of estimate where you're going to be. So how to pay estimated tax? Well, there are 5 ways to pay estimated tax. Firstly, you could credit an overpayment on your 2011 return to your 2012 estimated tax. Or if you're filing the 2012 return, you could have a refund apply forward to 2013. And you make this credit overpayment on line 75 of the 1040, and you enter what portion of the refund you want to see used to pay estimated taxes rather than received as a refund. That's a convenient way of dealing with an estimated tax situation. However, a few years ago, I did have a client who applied all of his refund forward to estimated taxes, and it was a big refund, like $6,000. He said, I just want to send that to estimated tax, then I don't have to worry about it. It's done for the year. But then he fell on financial hard times later in the year, and the first thing he thought about was, what about those estimated tax payments I sent in with my tax return? Is there any way I can get those refunded now so that I can have that money available? And the answer is no, there's not. So when you elect to have your refund from a current year return applied to estimated taxes, it's essentially an irrevocable election. Now, you can also make estimated tax payments through check or money order, using Form 1040-ES, and you would mail it to the address for the service center in your area. There are 4 estimated tax vouchers each year. I only have the first one shown, and the first one shown here is for April 17, 2012. If your client used estimated tax vouchers and on each voucher they mailed in, they wrote the dollar amount that they were sending in, and then they kept a separate record of that, that can be a really reliable system. But I did want to point something else out going on in the front of this estimated tax voucher. You see here it says your first name, your social security number, your spouse's first name, and the spouse's social security number. Well, when these estimated tax payments get processed, it's been my observation that the IRS processes the estimated tax payments under the first name listed on the ES voucher and doesn't process anything and apply it to the social security number of the spouse on the voucher. And if you have clients who make joint estimated tax payments during the year, but then file separately, getting the IRS to separate those estimated tax payments between the taxpayer and the spouse can be a bit of work. And ultimately, it's a good idea to save the canceled checks and make sure that you have those available if the IRS challenges the estimated tax payments that went into the system. And I actually have a client currently that we're helping through this. She made all of the estimated tax payments for the year off of her account. She and her spouse have separated. His social security was the first number on the vouchers she sent in, and right now IRS is saying she didn't pay anything. So we're helping her right now to argue with the IRS and send in copies of the canceled checks to show that and prove that she actually did make those payments. Now, another way you can make your estimated tax payments is electronically using EFTPS and by electronic funds withdrawal. If you are filing your federal return electronically, at the time you e-file your return, you can set up to have estimated tax payments withdrawn from your bank account on 4 quarterly dates throughout the year, but that election is made at the time you file, not after you filed. You can also make your estimated tax payments using your credit card, and these are companies through which you can make credit card payments. And penalty for underpayment of estimated tax. In general, you may owe a penalty for underpayment of estimated tax if you did not pay the smaller of 90% of the tax shown on your 2012 return, or the tax shown on your 2011 return. That is 100% of the tax shown on your 2011 return, or 110% of your 2011 tax if your 2012 AGI is more than $150,000 or more than $75,000 if you're filing separately. How do you figure the penalty? Calculate your penalty for underpayment of tax by completing Form 2210. If you do not complete Form 2210, the IRS will do it for you and send you a bill for the additional tax owed. You may be required to pay additional penalties and taxes if you do not pay your underpayment penalty by the due date of your return. And you may have to pay an underpayment penalty even if you owe less than $1,000 with your return. The penalty is figured separately for each quarterly payment due date. Therefore, you may owe the penalty for an earlier due date even if you paid enough later to make up for the earlier payment. This is true even if you are due a refund when you file your return. So let's think of an example what the IRS means by that. We've got a fellow named Jack, and he needed to pay estimated taxes in of $10,000 during the year, and he should pay those estimated tax payments quarterly. So he owed $2,500 in April, $2,500 in June, $2,500 in September, and $2,500 in January. But he missed the April payment, he missed the June payment, and instead he paid $5,000 in September and $5,000 in January. So then when he got to the end of the year, he'd paid in his full $10,000, but he hadn't paid it equally, and he had paid half of the year technically late. So what happens? He files his return, and actually when he files his return, he ends up with a $1,000 refund because his tax was less than he expected. Well, the IRS is going to look at how much estimated tax he paid in late, and they're going to charge a penalty on the estimated tax payments that were paid late. And they're going to subtract that penalty from the $1,000 refund that he's due, and he's going to get a check for less than $1,000. And even if he still owed when he filed, if he owed less than $1,000 when he filed, then he would be still assessed a penalty because he paid those first 2 quarters late. Now again, there are special rules for farmers and fishermen with respect to the estimated tax penalties. If you meet both the following tests, you do not owe a penalty for underpayment of your estimated tax for 2012. That is, your gross income from farming and fishing is at least 2/3 of your annual gross income from all sources for 2011 or 12. You filed Form 1040 or 1041 and paid the entire tax due by March 1st, 2013, then an estimated tax penalty will not apply to you, even if you paid no taxes in at all. Sting. S-T-I-N-G. Sting. And you can see when we're looking at question number 2, which is a C exam, both of these questions are C exam questions. And the C exam, in case you're not aware of it, is the special enrollment exam. It is the exam that you take if you wish to become an enrolled agent. And the IRS has published questions and answers to C exams for the period 1999 through 2005. You can actually go to the IRS website and find those exams. We take those exams, update them to current law, and publish them. So this exam is straight out of what the IRS threw in front of tax practitioners like me. I think I took the C exam in 2004, somewhere in there. At any rate, these are types of questions you can expect to see if you ever sit that test or have ever sat that test. The first question of these two is actually pretty simple. The correct answer is answer number D. It says James Lee had a total liability for 2011 of $20,000, and then in 2012, the taxpayer has a tax liability of $25,000. The taxpayer's withholding, however, has increased to $23,500, and he will file his tax return for 2012 on April 10 of 2013. To avoid the underpayment of estimated tax penalty, the taxpayer must. The answer is D, do nothing. He has satisfied the minimum tax payment requirements for two reasons. Firstly, he's paid in 100% of last year's liability. He's paid in more than 100% of last year's liability. Last year's liability was $20,000. This year he's paid in $23,500, so he's good to go. Even if he weren't good to go on that, we have to look at how much he's paid in compared to what he owes. He's going to owe $1,500 when he files, but it doesn't mean he owes an underpayment penalty because of it, because he has paid in 100% of the earlier year. But if you ask me, it looks like he's paid in at least 90% of the current year, and both of those are ways out of the penalty. So that makes D the correct answer for C, question number 2. Now moving up to C, question number 3 here. This one is a little bit more complicated. You have to pay attention to what it's saying, because this is a question that I bet you a lot of you are getting wrong because you're not reading the question, and others of you are getting it wrong because you're not sure of the rules. But let's see who got it wrong because they didn't read the question. This question says, Violet made no estimated tax payment for 2012 because she thought she had enough tax withheld from her wages. In January of 2013, she realized that her withholding was $2,000 less than the amount needed to avoid a penalty for underpayment of estimated tax. So she made an estimated tax payment of $2,500 on January 10, 2013. Violet filed her 2011 return on March 1, 2013, showing a refund due to her of $100. Which of the following statements is not true? So it's not asking which statement is true, it's asking which statement is not true regarding the estimated tax penalty. Well, by now, most of you have now switched your answers and selected the correct answer, which is B. But let's see what is wrong with all of the others. In other words, why A, C, and D are true. All right. Violet will not owe a penalty for the quarter ending December 31st because she made sufficient payment before January 15. That's true. If she was required to make her payments quarterly throughout the year, it means they were due on April 15 or April 17. They were due on June 15, September 15, and January 15. And if she made a payment in January by the 10th, that's before the 15th, so she made that final quarterly payment timely. So there wouldn't be a penalty associated with the final quarter, but there could be for the 3 earlier quarters. Option B, Violet will not owe a penalty for any quarter because her total payments exceeded her liability. Well, that is the false answer, and the reason that it is false is because the $2,000 of estimated tax she paid, she should have paid that $500 each quarter, $500 in April, $500 in June, $500 in September, and $500 in January. But she paid all $2,000 in January. So likelihood is she will owe a penalty because of that. But the next topic of the day, we could see a reason why she might not owe a penalty, how that would work if we file Form 2210, but we're not there yet. Violet could owe a penalty for one or all of the first 3 quarters of the year, even though she was due a refund. That is a true statement. And D, if Violet owes a penalty for any quarter, the underpayment will be computed from the date the amount was due to the date the payment is made. So if the payment was due on April 15 and she doesn't pay it, and it was actually April 17, and she doesn't pay it till January 10, the interest starts way back in April. And if she has another payment due in June, then the interest starts in June. If she has another payment due in September, the interest starts in September. The only payment that she made on time was the January payment. And that's why B is the only correct answer here. Okay, moving on. Form 2210 is the next topic of the day. Now, sometimes it can be the case that your client has an estimated tax penalty showing up on the tax software. Your software has generated a $300 penalty and slapped it on the return. And you're scratching your head going, well, where did that come from? Why do they have that penalty? And is there any way I can get them out of it? The answer is possibly there's a way to get them out of it. And the first thing I look at is the last year's liability. If your client is new to you, they haven't been your client before, your tax software won't know what their income and tax liability for the earlier year was. It therefore will assume that their liability for the earlier year is going to be some arbitrary number that it comes up with. I'm not sure what. And it will slap a penalty on the return. So one of the first things I do to eliminate a penalty from my client's return is find the point in my software where it asks for the prior year income and tax liability. And sometimes once I enter that information, the penalty disappears completely. But if it doesn't disappear completely, for all of the reasons why it should disappear, then maybe they're going to qualify for an exception to the penalty or for a reduced penalty. And if they do, I use Form 2210 to figure that. So you may request a waiver for some or all of the penalty if you can show the IRS that the underpayment was due to a casualty, disaster, or other unusual circumstance, and it would be inequitable to impose the penalty. Or in 2011 or 12, you retired after age 62 or became disabled, and your underpayment was due to reasonable cause. To request a waiver, you need to complete Form 2210, check box A or B in Part 2. And if you checked box A, complete only page 1. And if you checked box B, write down the amount you want waived in parentheses on the dotted line next to 17. And then you need to attach any pertinent documents and written statement to your return explaining the reasons you were unable to meet the estimated tax requirements and the time period for which you are requesting a waiver. So if you live in Oklahoma right now and a tornado has just come through and ripped up your community, that might be a reason why you would qualify for a waiver on your failure to make a timely payment. Now, you can also qualify for a reduced penalty, and this is the one I'm typically applying for. I don't deal with too many disaster victims. So most of the time when I'm asking for a reduced penalty, I'm not asking for a waiver. And you can ask for a reduced penalty if the income varied throughout the year. If your income was received unequally during the year, you can file Form 2210 to request the annualized income installment method. This method allows you to report income received in each quarter of the year. You use Form 2210 to determine the tax due for each quarter rather than for the year as a whole. And so let's look at an example here where annualization of income could reduce the penalty. Jed received a large amount of income from a land sale in the month of September. In September, Jed made an estimated tax payment that is equal to the tax he owes from the land sale. He made no estimated tax payments prior to that date because he had only nominal income. Jed, in that situation, would use Form 2210 to reduce or eliminate his underpayment penalty for the year. So in effect, what he would do is he would file Form 2210 to show the IRS when he got his income, and that in the first and second quarter of the year he had no income or he had very minimal income, and that the withholdings he had for those earlier periods were adequate for the income associated with those earlier periods. And that when he gets to September, the period in which he gets the large income, he then turned around and made an estimated tax payment equal to the tax owed on that income. So in that situation, Jed could use Form 2210 to completely wipe out any estimated tax penalty he has. So you can see here the form is divided into sections. In Part 1, you use Part 1 to determine the minimum amount of tax you should have paid to avoid the underpayment penalty. If you paid the required minimum, you don't owe the penalty. But if you did not repay the required minimum and you qualify for a reduced penalty or an exception, then you finish filling out the form. And in Part 2, you indicate the reason for filing. And the key reasons are that you're requesting a waiver from the penalty due to a reasonable cause, or you're providing information that shows that your income varied throughout the year. In Part 3, we have a short method which can be used to eliminate or reduce your penalty. And you can use the short method if either you made no estimated tax payments for the year at all, or you made all of your estimated tax payments in exactly equal amounts on the 4 installment dates. The other method is the long method, or the regular method, and you use Part 4 to eliminate or reduce your penalty if any of your estimated payments were late, or your income varied throughout the year, or you wish to allocate tax withholdings to the date paid rather than equally throughout the year, or you are filing Form 1040-NR. And if you look at the form, it essentially says what are your required installment payment dates, or what was the dates that you made them and how much were they. And then you get on to the final page, page 4 of the form, where it asks you to enter your adjusted gross income for each period. So in Jed's case, he might have no income in the first and second quarters, and even the third quarter, because September falls in the fourth quarter. And that's how it's working. It's saying, how much did you earn between January and the end of March? How much did you earn between January and the end of May? How much did you earn between January and the end of August? Well, if Jed has his land sale in September, it means these 3 columns will be blank, and he's going to put all of his income into column D. And that's how he's going to be able to minimize his impact of the penalty or eliminate it completely. The next topic of the day, briefly, is power of attorney form. We talk about this form far more in my course called IRS Ethics Rules Governing CPAs, Attorneys, and Tax Practitioners. Today, we're just going to briefly touch on it because it's also a place I wanted to bring in the discussion of the alternate form, there's a 2848 power of attorney, and then there's an alternate form 8821, and I wanted to put those two up against each other and compare them. You can authorize a tax practitioner or any other individual to receive information from the IRS by signing Form 8821 Tax Information Authorization. You may also authorize certain individuals to represent you before the IRS by signing Form 2848 Power of Attorney. Form 2848 allows an individual that you authorize to practice before the IRS on your behalf. And in order to do that practice, that individual has to be authorized to practice before the IRS. So they have to have the ability to practice. So you can't sign a 2848 for just anybody. It has to be signed and handed over to someone who can practice, even if it's just a limited practice before the IRS. And therefore, when you fill out the form, the power of attorney form, you have to indicate what kind of professional or other individual you are authorizing to represent you, either an attorney, a CPA, an enrolled agent, an officer of a company, a full-time employee of a company, a family member, an enrolled actuary, an unenrolled tax return preparer, a registered tax return preparer, a student, or an enrolled retirement plan agent. Only these individuals can be authorized to represent you before the IRS, and in certain situations, certain individuals cannot be authorized to represent you. For example, if you are trying to authorize an unenrolled tax preparer to represent you before the IRS, and that person did not prepare the tax return that they are representing you for, the IRS will not accept that power of attorney. So there's very limited authority to practice before the IRS that's granted to unenrolled tax preparers. And therefore, the IRS has Form 8821, which authorizes release of information. The power of attorney provides broader power. Now, in order to validate a power of attorney, it has to be signed. You, as the taxpayer, need to sign and date the power of attorney form. If you filed a joint return with your spouse, a separate Form 2848 must be filed for both you and your spouse. So you would file a 2848 authorizing the representative, and you would sign it. Your spouse would sign a separate Form 2848 and sign it, even if you both were on the same return with the same exact tax preparer. Limited representation for registered tax return preparers and unenrolled tax return preparers. Registered tax return preparers and unenrolled return preparers may only represent taxpayers before revenue agents, customer service representatives, or similar officers and employees of the IRS, including the Taxpayer Advocate Service, during an examination of the taxable period covered by the tax return that they prepared and signed. Registered tax return preparers and unenrolled preparers cannot represent taxpayers regardless of the circumstances requiring representation before appeals officers, revenue officers, counsel or similar officers, or employees of the Internal Revenue Service or the Department of Treasury. Registered tax return preparers and unenrolled return preparers cannot execute closing agreements, extend the statutory period for tax assessments or collection of tax, execute waivers, execute claims for refunds, or sign any document on behalf of a taxpayer. Now, all of these abilities are available to enrolled agents and CPAs and attorneys. So the IRS is going out of its way to say you can't do these things if you are a tax preparer who is not an attorney, an enrolled agent, or a CPA. If a registered return preparer or an unenrolled return preparer does not meet the requirements for limited representation, then they can't have a power of attorney at all, and they move over to the 8821. And 8821 is used to release information, and I actually see people signing 8821s when they're applying for bank loans these days. If you're applying for a mortgage to buy a house, the bank that's lending you the money will very often ask you to sign an 8821 so that they can go directly to the IRS and receive transcript details of your income that have been filed with the IRS and basically see that you're reporting the income you say that you made and that you aren't making up fake tax returns and giving fake tax returns to the lender. So that does go on. Signature, if you are filing an 8821, exactly the same as with the power of attorney form. Separate 8821 must be filed by each taxpayer and spouse. They cannot share a joint form. And the next topic of the day is amended returns. And hey, wasn't that the title of today's course, Amended Returns? We're waiting this far into the program to get to it because essentially I think of an amended return as something that comes after the return's been filed, right? Now you're going back and fixing your mistakes. So if you made an error on your tax return, you can file Form 1040X to correct the error and receive a refund or pay any additional tax owed. Here's a caution, however. An amended federal 1040 return cannot be filed electronically at this time. However, the IRS does accept current year Form 1065 and 1120 series tax returns electronically as amended returns. Not the 1040 though. Now, if you're amending your state tax return, either with or separately from your federal return, some states do allow e-file of amended returns, but the IRS currently does not. When do you file the Form 1040-X? Form 1040-X is filed only after you have filed your original return, and generally you must file Form 1040-X for a refund or credit within 3 years, including extensions, after the date you filed your original return, or within 2 years after the date you paid tax, whichever is later. A return filed early is considered filed on the due date, generally April 15th. However, if you had an extension to file, for example, until October 15, but you filed earlier, your return is considered filed on the earlier filed date. Federal 1040-X. You should correct your return if, after you have filed, you find that you did not report some of your income. You claimed deductions or credits you should not have claimed, or you did not claim deductions or credits that you should have claimed, or you should have claimed a different filing status. Generally, however, once you file a joint return, you are not allowed to switch your filing status from joint to separate after the original due date of the return. And here is the 1040-X. This form is filed hand in hand with the 1040. You don't mail in 1040-X all by itself. The IRS already has a copy of the original 1040 return filed. If you're going to amend your return, what you're going to need to do is prepare a whole new 1040 based on all of the facts and circumstances related to the correct situation. And then you line up the original return with the corrected return. You fill out Form 1040-X. And then when you mail in 1040-X, you attach the newly corrected return behind 1040-X along with any other additional forms or schedules that are new or added or changed due to the amendment. There are some special situations where you should read the instructions for 1040-X carefully. If you are amending the return for any of the following reasons, IRS says read the 1040-X instructions and then go to further reference points. One of them is if you are amending a return because of certain airline payments that were rolled over into an IRA, or you are doing a carryback claim such as a net operating loss. NOL carryback claims are incredibly complicated to figure out. And filing 1040-X is usually not nearly enough effort. You're usually going to have to do a lot of work in calculating the correct NOL, including the NOL under alternative minimum tax rules as well. Carryback claim credits or other losses, you would need to do further research into how you do the carryback on those. Deceased taxpayer, household employment taxes, injured spouse claim, qualified reservist distributions. If you qualify for relief from the 10% early distribution penalty, that might be a reason to file for an amendment. Reimbursement received for hurricane-related casualty loss, relief for homeowners with corrosive drywall, and student loan forgiveness for healthcare professionals working in underserved areas. Those are all topics that are addressed in the instructions for 1040-X, but I'm not going to cover them in any other detail. Preparing your amended federal return, you follow these procedures. You begin by preparing a new Form 1040 and attaching all the correct schedules and forms. You then compare the numbers shown on the original 1040 with the numbers on the corrected 1040. You then complete Form 1040-X. Now with tax software, we typically don't have the current return and the original return lined up on the desk in front of us. Typically, we've got the original return on the desk and we've got the corrected return in the computer, and the computer therefore already knows what to put in column C, the corrected column, and we have to tell the computer what to put in column A of the 1040-X. And there's two tax items that I consider to be advanced, that I don't want my first and sometimes even my second year preparers on staff touching. One of those is state tax returns when we're dealing with out-of-state situations. My preparers are pretty well trained on Oregon law, but anytime they're dealing with a California situation or a situation for income from any other state, I don't want my inexperienced preparers touching those returns because they're bound to make an error. And I kind of think the same thing about a 1040-X. Although a 1040-X should be simple, the actual data entry that's required in a computer to make it come out right can be difficult to achieve, particularly for an inexperienced preparer who has no clue what they're doing. And so I created this course really in mind to teach people what a finished 1040-X looks like, so that if you're preparing a 1040-X in your software, you know when you got it right, because it needs to have all of these items put into it. So here we have an illustration. And our characters in this story are Fraser and Lilith Crane. They moved from Pensacola, Florida to Albuquerque, New Mexico on October 10, 2012. They prepared and filed their original 2012 return using TurboTax, but did not claim moving expenses or educational expenses because they did not believe they were eligible, and now we've figured out that they are. The Cranes have now been advised that they are eligible to deduct their moving expenses because Fraser worked 39 weeks in the 12-month period that began on arrival at their new home, and they had the following moving expenses. They have a U-Haul one-way rental costing $1,200. They paid gas for that U-Haul, $1,400. Lilith drove the family car. Labor to pack the household goods and load them into the U-Haul was $300. Labor to unload the household goods and bring them into the new home was $200. Lodging the last night in Pensacola was $100. Lodging along the way to Albuquerque was $200, and meals along the way were $100. And then we had Lilith do a map quest, and when she did that, she came up with the route that they drove, point A to point B, and we can see that based on that route, she drove 1,345 miles. Lilith finished her BA studies in May of 2012. Her 1098-T is attached. She has not claimed any educational expenses on her return in earlier years. This is her first bachelor's degree, and she has no felony drug convictions. Well, the first thing that's going through my mind is she's eligible for the American Opportunity Credit, but she was probably eligible for it in the 3 earlier years as well. So maybe we should go back and amend earlier years, not just 2012. That's what's on my mind. But for now, we're doing 2012. And here is a copy of the Cranes' original return and their amended return all lined up. We can see that the wage income was $76,500. That is unchanged. But now we have moving expenses. And I have billed the $3,903, but it's not right here in front of us right now. But we come up with $3,709 of moving expense. So her adjusted gross income on her amended return is less than her adjusted gross income on her original return. And she's going to enter $76,500 in column A of 1040X, and she's going to enter $72,779 in column C of 1040X. And then she'll enter the difference, which is $3,709 in column B. We then go over and compare other lines on the 2 tax returns. This is her original return. This is her amended return. And we can see that the standard deduction on both is the same. So columns A and C will be the same, and column B will be 0. We look at the exemption deduction. That's the same on both returns. Therefore, columns A and C will be the same, and B will be 0. But then we get to taxable income, and there's a difference, except because the amended return doesn't ask for the taxable income. You'll see in a minute that it doesn't. And then it asks for the tax. We can see here that the tax on the original return was $76.84, and on the corrected return it's $71.21. And we're going to take those amounts over to the 1040X and enter those on line 6. The original return, we're going to enter $76.84 in column A on line 6 of 1040X, and we're going to enter $71.21 on column C of 1040X. We also need to pull the original tax refund that was received off of the amended return and enter that on the 1040X. That's going to go on line 17. And on the original return, we had 0 credits being claimed, but on the amended return, there's a $1,500 credit that Lilith is claiming. And so we're going to enter that in column C of line 2 of the amended return. She also has an American Opportunity Credit, which is a refundable credit, and that goes on line 14 in column C of 1040X. And we show that she's due a refund on the amended return of $3,904, but we have to remember she's already received $841. So if you take $841 and subtract that from $3,904, when we're done with the 1040X, that should be the refund that shows on the 1040X, and it shouldn't be a number other than that. And here is the 1040X. We start at the top by entering an X in the 2012 box to indicate that we are amending a 2012 return. We enter the address for the amended return. Speaking of addresses on amended returns, I'm going to just point out that when you're preparing an amended return, be careful to make sure that the address that you're now going to use for the amended return is correct. Because if you just copy the address that's on the original return, your client may have moved. Or if the client's entered into your tax software, the software is going to remember where they lived on the original return. So you want to be sure when you're preparing that amended return that you get the address right. It's rather embarrassing when that small detail is overlooked. The refund goes to the wrong place. Happens frequently, I have to point out. So here we have the amended 1040X, and we can see we have the filing status that needs to be checked, married filing joint. And we have the columns, the original column, the correct column, and the difference between the two. And on the original column, we show AGI from the original return. Column C, we show AGI from the corrected return. And in the middle, we have the difference. And the difference is, of course, the moving expenses. We then get down to line 6, and we go look up the tax from the tax tables. On the original return, it was $76.84. On the corrected return, it's $71.21. The tax has dropped by $563. But then we go on to credits. And on the original return, there were 0 credits. And on the corrected return, we have a $1,500 American Opportunity credit. So the credits have gone up by $1,500. So overall, the tax has dropped by $2,063. And then on top of that, we also have the refundable portion of the American Opportunity credit. So what we do then is we look at the withholdings on the original return and on the corrected return, and those are unchanged. We have $8,525 of withholding on both returns. We can go up here and see $85.25 and $85.25. That number has not changed. But the payments have changed because the American Opportunity credit is treated as a payment. So $85.25 is added to $1,000, and now we have total payments applicable to the amended return. And from those payments, we subtract the previously received refund to get the net payments for 2012 amended return after accounting for the previously received refund. And when we do that, we then have $86.84. From $86.84, we subtract the tax of $56.21, and when we do that, we get $3,063. Ultimately, $3,063 should be what we get when we subtract $841 from $3,903. Either way, you should still get that same $3,063 number. Here's page 2 of the 1040X, and in page 2, we need to provide a description of the reason for the amendment. And here we're saying line 1, adjusted gross income on the 1040X has gone down because of moving expenses. 3909 is attached. Line 7, a non-refundable education credit has been claimed. Line 14, a refundable education credit has been claimed, and then a refund is due. And then, of course, we have space here to sign the return. Now, in this section right here, we only fill out Part 1 for exemptions if there has been a change in the number of dependents or exemptions being claimed on the return. The exemptions are exactly the same on the original return and the amended return, so we don't fill in Part 1 there. Here is the $88.63 for Lilith. Here is the $39.03 for the Cranes, and that is the amended return for them. Now, when you assemble the amended tax return, you put the 1040X on top, and you have the client sign page 2 of 1040X. Then underneath 1040X, you would put the 1040 as well as the 8863 and the 3903, and you would assemble those according to the sequence codes here. You can see sequence code 170. Compare that to sequence code 50. What it means is that the 8863 goes on top of the 3903, even though the 3903 has a smaller number numerically than the 8863. Refund, if you are requesting a refund with Form 1040X, expect it to take about 3 months to get processed. I do have some clients tell me they get it sooner, but IRS says expect 3 months. For a balance due, if you owe additional tax with the return, you need to pay the balance due with the amended return, but you also have to remember that when you owe interest on what you owe, and sometimes you also owe a penalty on what you owe. And if you do not include the penalty and interest with what you owe, the IRS is going to send you a bill. Typically, I find it much easier to tell my clients that they're going to get a bill than it would be to make any attempt to figure out what the difference would be, because it wouldn't be easy. You'd have to do all these manual calculations to figure out what penalty and interest they would owe, whereas the IRS will figure that for them and just send them the bill at no additional charge. So I just make sure that I let my clients know that if they do owe, that the amount I'm showing on the return as a balance due is far from what they owe. In other words, that they will owe more and above that, and the IRS will let them know what that is. And the last couple of topics of the day that we're going to cover today are the tax on investment income of certain minor children. Now, to prevent wealthy individuals from avoiding tax by turning their investment income over to their minor children, the government created the Kiddie Tax. The Kiddie Tax is assessed against investment income that exceeds $1,900 for a minor child who was under age 18 at the end of the year, and for certain children who are age 18 on the last day of the year, and for certain full-time students over the age of 18 and under the age of 24 at the end of the year. There are two different ways that the kiddie tax is assessed. One way is by filing Form 8814 and reporting the child's income on the parent's return. The other is by filing Form 8615, figuring the kiddie tax and paying the kiddie tax on a tax return that is actually filed by the child. We'll cover 8814 first, which is the parent's election to report the child's interest and dividends on the parent's tax return. If your child's interest and dividend income, including capital gains distributions, totals less than $9,500, you, if you are the parent, may be able to choose to include your child's investment income with your tax return. If you choose to report your child's investment income on your return, you should file Form 8814. If you choose to include your child's income on your return, your child's income will be taxed at your higher rate. To be able to make the election, your child's income must come from interest, dividends, including capital gain distributions shown on Form 1099 DIV, or from Alaska Permanent Fund dividends. The income cannot come from any other source, including the sale of stock or other property. In that case, Schedule D must be filed and the child must file Schedule D with his or her own return. Nor can it be used if the child had income from wages or other earnings or any other form of income received by the child that is not interest or dividends. Making the election. To make this election, you must be the parent of the child. If you and the other parent of the child do not file a joint return, you should refer to the chart on page 82 of the manual. And on page 82 of the manual, I have a chart taken from IRS which illustrates which parent's tax return you should use when you are figuring the amount of kiddie tax that needs to be paid for a filer. You can make the election to report your child's income on your return if all of the following conditions are met. Number one, your child was under age 19 or was under age 24 and a full-time student on January 1, 2013. Your child is required to file a return if you do not make the election to include their income on your return. Your child had income only from interest or dividends. The gross income was less than $9,500. No estimated tax was paid under your child's Social Security number. No federal income tax was withheld from your child's interest or dividend income under the backup withholding rules. You are the parent whose return must be used when applying the special rules for claiming child's income, and the child does not actually file a return. If you meet all of those tests, then you can file Form 8814. There are advantages and disadvantages to filing Form 8814 and including the child's income on your return. The advantages are relatively minor, and quite frankly, I don't normally recommend it, but let's read what they are. Firstly, there's no need to file a separate return for the child. Secondly, the parent's investment income is increased, which may allow a larger investment interest deduction. We'll cover investment interest deduction in Schedule A course next week. The ceiling for charitable contributions is increased, and the first $1,900 is not included in the parent's taxable income. This may reduce state tax liability in states that base tax on the federal taxable income. But what are the disadvantages? And the disadvantages are such that I have seen situations where 8814 caused a significant tax increase to a filer and even took away refunds that they might potentially have received, which actually caused us to amend their tax returns. So let's look at the disadvantages. And the first one that I'm even mentioning here is the reason why we amended a client's return. A disadvantage of including the child's income on the parent's return is that the AGI, the adjusted gross income of the parent, goes up. And when the AGI of the parent goes up, they phase out on their ability to claim certain tax benefits, including, in our client's case, the earned income credit. The earned income credit has a rule that says if your investment income goes above $3,600, $3,700, you lose the earned income credit. And the child's investment income of $4,000 was put on the parent's return. The parent was otherwise a relatively low-income filer, and therefore they could have had earned income credit and didn't get it because the preparer put the child's income on the parent's return. So we amended that client's return to get the child's income off the parent's return, and then the parent got the earned income credit. The child then went and turned ahead and filed their own return. So another reason why AGI might cause a reduction in tax benefits for the parent is the child independent care credit could go down, child tax credits may be reduced. Some states will tax more if the adjusted gross income goes up. For example, California and Oregon are two states that base the state income tax on the adjusted gross income flowing through from the federal return, and so it's not a good idea to include federal income without understanding those ramifications. Also, the child's income may be taxed at a higher rate than it would on their own return. So putting the child's income on the parent's return may not be the best way to do it, and your child may miss out on the following deductions: higher standard deduction for the blind, penalty on early withdrawal from savings, and their own itemized deductions if they do have itemized deductions to claim. But let's just suppose we have a situation where we have a filer who does want to file 8814. How do you go about doing it? What would it look like? How do the numbers work? Here's an example. Our character this time is J.R. Ewing, and he is reporting $50,000 of wage income. He is also electing to report interest income of $4,500 and ordinary dividend income of $1,000 earned by his dependent son, John. The 1040 tax table amount for line 43 of JR's Form 1040 is shown here, and we can see that based on his income and his deductions, I'll show you in a minute, he had a tax liability for the year, or a taxable income for the year, of $40,050, and his tax based on that taxable income amount is $6,049. You need to figure the parent's tax by including the child's income in the parent's income, going to the tax tables, figuring the parent's tax after you include the child's income in the parent's table, and then you go back and finish filling out Form 8814. So 8814, the starting point is we enter the taxable interest of the child John. That was $4,500. We then enter the ordinary dividends of the child John. I have not given him any qualified dividends simply because I didn't want to have to figure a capital gain worksheet. Keep the problem simpler. So we have 45 plus 1,000. That gives John $5,500 of income. But there's a number here, $1,900. If his income is over $1,900, we subtract $1,900 from $5,500, and we get a number, $3,600. This $3,600 is the amount that JR will add to his income. And he does that by going over to his 1040 form. We go over to line 21 of JR's federal return, and on the line 21, we type 8814 and the amount of income flowing from the 8814, which is $3,600, and we enter it on the line. When we do that, we add that, and we get his total income being a higher number, including his wage. So in this case, his wage was $50,000. He takes JR's income of $3,600, and he ends up with $53,600 of income on line 22 of his return. We then go over to the Form 1040 and enter the tax. Well, the tax you can see here is $6,144. That is not the tax that I had right here of $6,049. And why is that? Well, on the Form 8814, there's another calculation that goes on. Remember this $1,900 up here? Of that $1,900, $950 is not taxed at all because that's John's standard deduction. He's allowed $950 of tax-free income. And the difference between $950 and $1,900, which happens to be another $950, is going to get taxed at a rate of 10%. So we take $950, multiply it by 10%, which is the lowest tax bracket that John would qualify for, and you get $95. We take $95 and add that to the tax shown here of $6,049, and when you do that, you enter the total, which is $6,144 on JR's return. And we'll check box X for line 44, which says Form 8814 is attached, and the amount of tax being reported on the form is $95. So that's how you prepare the 8814. Let's compare that with 8615. If a child's interest, dividends, and other investment income totals more than $1,900, part of that income may be taxed at the parent's tax rate instead of the child's tax rate. If the parent does not or cannot choose to include the child's income on the parent's return, use Form 8615 to figure the child's tax and then attach that form to the child's tax return, not the parent's return. Who must file Form 8615? Well, 8615 must be filed for a child if all of the following statements are true. The child's investment income was more than $1,900, and the child is required to file a return for 2012, and the child was either under age 18 at the end of the year, was age 18 at the end of the year and did not have earned income that was more than half of his or her support, or was a full-time student over the age of 18, under the age of 24 at the end of the year, and did not have earned income that was more than half of his or her own support, and at least one of the child's parents was alive at the end of 2012, and the child does not file a joint return for 2012. Figuring the Kiddie tax on Form 8615. Follow these steps to compute the amount of Kiddie tax owed. Refer to the chart on page 82 of this manual, which says which parent's return to use when calculating tax on the investment income of certain minor children. Then figure the child's tax on Form 8615 using these steps. In Part 1, you figure the child's net investment income, which includes income from interest and dividends, capital gains, Social Security, pension payments, certain kind of trust income, and rental income. You then figure a tentative tax on the net investment income based on the parent's tax rate, and you figure the child's tax. Well, here is the form. You can see in Part 1 we figure the child's investment income. Then in Part 2 we figure the tentative tax based on the tax rate of the parent. Well, in order to figure the tentative tax based on the tax rate of the parent, we have to have a copy of the parent's tax return because we're going to need to pull some numbers off of it. So I have an illustration, and let's see how it works. In this illustration, we have a character named Richie Rich. He's age 10. He is the dependent child of Richard and Regina Rich, and during the year, Richie received $20,000 of ordinary dividend income. A copy of his parents' Form 1040 is shown below. Prepare Richie's tax return. So this is the tax return of Richard and Regina Rich, the parents. And we can see, looking at Richard and Regina's return, that they have taxable income on line 43 of $447,400, and then on line 44 we've figured $125,730 of tax using Section B worksheet. We calculated this tax amount of $125,730. We need these two pieces of information in order to prepare Richie's Form 8615, so let's now go do that. And the starting point is to figure Richie's tax return. On line 9A, we enter his ordinary dividend income. That was the only income he had for the year. I wanted to keep our illustration as simple as I could. We move over to page 2 of his 1040. Because Richie is the dependent of his parents, his standard deduction is going to be limited to only $950. He subtracts $950 and ends up with taxable income of $19,050. Now, Richie at this point cannot go to the tax tables like an ordinary filer would and figure his tax on that $19,050. He's going to have to do Form 8615 and figure his tax there. And if you look at the tax that we're going to get, the tax we're going to figure is $6,431. That's an awfully big number based on his income, isn't it? And let's see why. We have the 8615 form, and on the first line, we enter $20,000 of income. On line 2, we subtract out $1,900. $950 is Richie's standard deduction. The other $950 is the amount of income he's allowed to have taxed at the lower 10% rate. And everything above and beyond that, $18,100, is going to get taxed at his parents' rate. Then on line 6, we enter the amount of taxable income shown on line 43 of Richie's parents' return. On line 8, we add line 5, which is Richie's income after subtracting $1,900, to his parents' income, and we get a total income on line 465, a total taxable income amount. From there, we go down and figure Section B for the married filing joint filers and the amount of tax that would be owed on that amount of taxable income, $465,500. That's Richie's income added to his parents' taxable income, and we get $132,064.50. The software rounds that up to 65. $132,065. The next step on line 10 is to enter $125,730. This is the amount of tax that Richie's parents owe on their income alone, and then we do a subtraction. $132,665 minus $125,730, we get $6,335. That is the amount of tax that Richie owes based on his parents' tax rate on his income, but we're not done. He still has to pay tax at a rate of 10% on that $950, and for whatever reason, the math software makes that $96 rather than $95. We're going to add 96 to 6335, and that's where we get the 6431. We take 6431 up, smack it on line 44, and you have Richie's 8615 completed. Okay, and then we are fairly much done with the class, so I'm going to finish with this table that I was promising you, and then the class will be over. The table is used to determine which parent's tax return you will use when calculating the tax on investment income of certain children. The Kiddie tax is applied to the investment income of a dependent child to prevent the income from being taxed at the child's lower rate. In situations where the parents are divorced, separated, or filing a separate return, rules must be applied to determine which parent's income will be used to figure the tax of the child. And I've tried to categorize these areas by highlighting them where they go together. The first is the filing status or situation of the parents. If the parents are married and living together and they file a joint return, you will use the parent's joint return. But if they are married, living together, and file separate returns, you will use, of course, the return of the parent that has the higher income. If the parents are married and did not live together, and the custodial parent is filing married, filing separate, then you will use the return of the parent with the greater income. But if the custodial parent is filing head of household, then you will use the return of the parent who had custody for more than half the year of the child for whom the 8615 is being prepared. If the parents are divorced and the custodial parent has not remarried, then you will use the tax return of the parent who had custody for more than half the year. If the custodial parent has remarried and the custodial parent and the step-parent file a joint return, you will use the custodial parent's joint return. But if the custodial parent has remarried and the custodial parent and the step-parent live together and file separately, you will use the parent or step-parent who had the higher income. If the custodial parent has remarried and the custodial and the step-parent do not live together and file separately, then you will default back to the rules for parents married and not living together. If the parents were never married but lived together all year, you will use the parent who had the higher income. If the parents never married but did not live together all year, then you will use the parent who had custody for more than half the year. And if the parent is widowed and then remarried, you'll fall back on the rules for the custodial parent remarried. So that concludes today's class on amended returns, tax penalties, and the Kiddie tax. So if you can flip to the end of your manual where we show a classwork assignment, and we're going to be preparing a tax return here, an amended return for Mary Poppins today. And we've done the added help there for you of telling you that Mary will need a 1040, a 1040X, an 8812, an 8863, an 8867, and an EIC to prepare her return. And so we're just going to take a look at what it is and the reasons why she's amending her return, and then I'll put up the answer key. Mary Poppins needs to amend her 2012 return, and Mary did not claim her younger sister Laura as a dependent on her original return. During the year, Mary provided more than half of the support for her sister, Laura Poppins, who lived with her all year while she was attending college. Kind of slipped Mary's mind. She didn't know she could claim her sister, and she didn't. Laura paid $2,000 for tuition and fees expenses that she incurred while in her third year of full-time studies. Mary's original return also failed to include income from a second job that she worked at part of the year. That W-2 arrived too late. She filed without it. Now she realizes she left it off, so she's amending for that as well. And this is the W-2 that she left off. A copy of Mary's original filed return is included next for reference in preparing Mary's amended tax return. So here is Mary's original return. We can see her wage was $36,100. She claimed the head of household filing status, and she claimed a single dependent, Jane, who qualifies for the child tax credit. So we can see here her exemption count is 1 for the filer, 1 for a dependent child, and a total of 2. That's important because you need to pay attention to those when you're filling out the amended schedule. Then on page 2, we have a head of household standard deduction of $8,700. We claim $7,600 of exemption deduction. We had taxable income of $19,800 and a tax bill of $23.54. We then claimed an education credit for Mary's education expense of $240, and we claimed a child tax credit for Mary's child in the amount of $1,000. Her tax liability is $1,114 after claiming her credits. And then we get down to line 62, where she had $1,500 of federal withholding, and she had an American Opportunity Credit refundable portion of $160 and a refund of $546. So let's take a look at Mary's amended return. Increasing Mary's income and adding an additional dependent changes her tax situation significantly. Her AGI is increased. However, she is now eligible for additional credits as follows. Her child tax credit is dropping from $1,000 to $869 because Mary is using up most of her child tax credit and all of her non-refundable education credit, and it's essentially wiping out her income tax. Mary can claim an American Opportunity Credit on her sister Laura's educational expense as well as her own, even though Laura is the one that paid the education expense and not Mary. So Mary's claiming a refundable education credit as well as a non-refundable education credit relative to Laura's expense. The additional child tax credit has gone from $0 to $131, and now Mary is also qualifying for $490 of earned income credit. It appears she qualified for it on the original return too, she just never claimed it. So we're going to get it all down here. And here we have Form 1040X coming up. And we show Mary Poppins and her amended return, and obviously we need to look at her corrected return. On the corrected return, we have now listed two dependents, Jane and Laura, and you can see we also have line 7 showing the wage income has increased. And on page 2, we're showing the education credits, we're showing the child tax credit, we're showing the refundable credits down below. When we translate all of that over to the 1040X, we're going to fill out the columns as appropriate. We show in column A the original return, in column C we show the corrected return, and in column B we show the difference between those. When we get down to the taxable income, though, the taxable income actually drops. And the reason that it does is that the extra deduction that Mary gets for claiming Laura as her dependent means that her taxable income is down by more than the extra income she's reporting. And therefore, her tax is also down by $45. We then go over to figure her tax liability, and we have in column A the original liability, in column B we have the corrected liability, and the difference between those at $45. The credits, we have the original credits, we have the new corrected credits and the difference between those, and then we have the total tax liability on the original return was $1,114, but on the corrected return the liability is now 0. Finally, on line 17, we do show the amount of refund received with the original return at $546, and we show a refund of $31.35. When we go over to page 2, remember when we did the illustration earlier for the cranes, we didn't fill out part 1 because we had no change in the number of exemptions. But for Mary Poppins, we do. We do have a change in the number of exemptions, and so on page 2 in part 1, we're going to show the original number of exemptions claimed on the original return. And for Mary, that's the same. The filer exemption, the taxpayer exemption, is 1 on the original, 1 on the corrected. But for dependent children who lived with Mary, it was 1 on the original return. It's 2 on the corrected return for a net change of 1. And then we have multiply the number of exemptions claimed on lines 27. Well, that has gone up. It was 7,600 on the original, 11,400 on the corrected for a difference of 3,800. And then we're asked to list the dependents, Jane and Laura. Then we have a description of the reasons for the amendment, as you can see. So that is the final on the review of the classwork answer key. And again, you can go look at that if you want. You'll notice in the manual there's also a homework assignment. Trekkers. Trekkers. Trekkers.